Good morning, everyone. Welcome to the November 13th meeting of the FASB's Public Market Advisory Committee. I'm Alicia Manders, Assistant Director at the FASB, and I'll be chairing today's meeting. Today, we're pleased to have all of you around the table that were able to make it in person, as well as a number of members who are joining virtually from various locations. So we really appreciate the efforts that you made in trying to get here, and we're happy to have your participation either way. Also joining us throughout the day will be a number of FASB team members. So they're joining us for various sessions today. I just want to mention a few people who are joining us today for the first time. So Lynette Kelly over on the side serves on our trustees of the FAF. Lynette is the former president and CEO of the Municipal Securities Rulemaking Board and has over 30 years of experience in business, legal, regulatory, and a lot of other areas. So we're really happy to have her today. Lynette chairs the FAF Trustees Appointments Committee and is a member of the Executive Committee. So if you haven't had a chance to meet Lynette, please introduce yourselves during one of the breaks. Although it's not the first time, I also wanted to just mention that I'm really happy to have Jerry Shaver here as the chair of the PCC, who will be joining us for a session later on. And then Janice Jang, who's our new FASB post-technical assistant, who joined the organization in July for a one-year term after completing her bachelor's and master's at the University of Illinois with concentration in financial reporting and assurance and data analytics. So happy to have you as part of the team, Janice. Given the mixed meeting format, Lucy's going to help me keep track of the queue for when the discussion gets more active. So for those that are joining on Zoom, we will look for your raise your hand feature on Zoom. If you can't find that, you can use your physical hand. For those that are joining here in the room, if you could do our normal, turn your card up on its end when you want to jump in, that would be great. And then push your mic button to turn on and turn off when you're done as well. Otherwise, the camera will stay on you. So with that, let's go ahead and go introductions around the table, starting in this room first. And so I'll turn to Lucy.
Thanks, Alicia. Lucy Chen, FASB staff.
Alden Schrader, FASB postgraduate technical assistant.
Janice Jang, FASB postgraduate technical assistant.
Erica Friend, FASB staff.
Stephanie Wiskowski, FASB staff.
Christina Katmeyer, FASB staff.
Bob Rook, managing director at Alvarez & Marsal.
Fred Cannon, FASB member.
Marcel Snyman, Grime Holdings Company Chief Accounting Officer.
Sue Cosper, FASB.
Jackson Day, Technical Director.
Randy Oberdick, Forvis Mazars.
Rich Jones, FASB Chair.
Heather Jossam, PCOB, Office of the Chief Auditor.
Dude Forrest, Cold Spring Construction Company.
Hillary Salo, FASB Vice Chair.
Hi, Michelle Reynolds, Chief Accounting Officer at Reddit.
Joyce Joseph, FASB member.
Jason Kais, partner at KPMG.
Greg Wayna, career as an interim CFO, multiple different industries.
Christine Bodison, FASB member.
Jared Goodman, portfolio manager at Colorado Pair.
Rosemary Sangiulo, FASB Deputy Technical Director.
Billy Dubler, FASB Deputy Technical Director. Jennifer Weiss, FASB staff.
Marcia Hunt, FASB member.
Terrific. Thank you. And for those on the screen, Uraj?
Hi, Uruj Khan, professor at the University of Texas at Austin.
Penny?
Good morning. Penny Pepperling, Assurance Practice Leader, BDO.
Stephen?
With Stephen Yang, I'm with Grand Capital.
Ryan?
Hi there, Ryan Surak, CFO, EverCommerce.
Rocky?
Good morning, Rocky Kumar, advisor and board member in healthcare.
And Shubha?
Hi, good morning. Shubha Ghosh, Managing Director at Opti Capital.
Terrific. So as you can see from the agenda, we have a lot to cover today, and we're very interested in hearing your views and input on a variety of FASB technical and research projects. This morning's sessions are a bit different from past meetings, as we'll have a series of updates and ask for PMAC members' feedback and questions on a wide range of topics that are on either the FASB's current agenda, potential topics for the FASB's future agenda, as well as recent PCC topics. This afternoon, we'll go deeper into two FASB projects, one on the accounting for derivatives, which is on our research agenda, and then the second on current expected credit losses on CECL, which is a post-implementation review project. We'll finish our discussions with a session about the use of technology and AI, asking for member feedback on how the effects of technology should be considered in future standard setting. So before getting into the first topic, I just want to mention that we do have three PMAC members who are completing their terms at the end of this year. So that's Jessica Dolan, Jonathan Tomaszek, and Ryan Suryak. Unfortunately, Jessica and Jonathan had other client commitments and other commitments that arose recently, and they were unable to join for their last meeting, but they did express their appreciation for the chance to be part of this group, to contribute to the discussion, and to work with all of you. Ryan's also joining us virtually, and I just want to thank Ryan for his active participation throughout his term. On many different topics, but also being a mentor and showing what somebody who used to be a PTA years and years ago at the FASB could do in your career. And it's really been a pleasure to have you come back. So just a warm thank you to all of you for your participation throughout your term.
Thank you.
We will be looking, thanks, Ryan. We will be looking to add some new PMAC members at the beginning of 2026, and we greatly appreciate all of the candidates that some of you have put forward. So if you do have suggestions on potential candidates for us to consider, either for 2026 or in the years to come, please reach out to either me or Lucy with any suggestions. So with that, let's go ahead and get started with the FASB update. I'll turn to Nellie Debler.
Good morning. Thanks, Alicia. Excuse me. We wanted to provide a few updates on items on our agenda that we are kind of ongoing or have recently completed. We've talked about several of these with the PMAC over the years. We really appreciate the feedback we've gotten from you all, the perspectives that you all have been able to share. We've been able to incorporate that feedback kind of as we've gone through this, all the rest of the feedback obtained through the process. So this is just an update on where we are, what's going on with these. We've got 5 projects to update you on, as you can see on this slide, and happy to take questions on these as we go through them. So first, I'd like to talk about a recent EITF issue on the accounting for debt exchanges. We talked about this with PMAC in the fall of 2024, right after the issue had been initially discussed by the EITF. So under current GAAP, when an entity modifies or exchanges debt instruments, an entity is required to determine whether that should be accounted for as a modification or an extinguishment. And that stakeholders noted that in that current practice, in some cases, doesn't reflect the economics of the transaction. When the issuance of the new debt and the paying down contemporaneously of the old debt are independent transactions, modification accounting in particular may not reflect the economics of that transaction. The other thing we hear pretty consistently is that the current guidance on that quantitative test of cash flows to determine whether something is a modification or extinguishment is complex and challenging to apply. So the EITF recommended that the board specify that exchanges of debt instruments that meet certain requirements should be accounted for by the debtor as the issuance of new debt and the extinguishment of the old debt. Specifically, the criteria are the existing debt obligation has been either repaid in accordance with its contractual terms or repurchased at market terms. And then the new debt was issued at market terms. And when you meet those requirements in this kind of exchange situation, an entity would not need to provide a quantitative analysis of the changes in cash flows. So these will apply to debtors that enter into transactions within the scope of the guidance in 47050. And again, involving the contemporaneous exchange of cash between the same debtor and creditor in connection with the issuance of a new debt obligation that includes multiple creditors in it. We exposed this for public comment in April. We got a fair bit of feedback on this and a little bit of attention. The board deliberated this guidance through the summer, and we're working through the final drafting process and hoping to issue the final update, hopefully in the first quarter. Any questions or comments on that one? Okay, moving right along. The next one on our list is the accounting for environmental credit programs. We last discussed this project with PMAC in June of 2024. We've talked about this, I think, a couple of times. Since it's been a while, I'll kind of level set where we are with this project. This project addresses the accounting for environmental credits and the associated environmental credit obligations. But this is one where I want to explain briefly what the project doesn't do. So this project doesn't address the accounting for carbon emissions. It doesn't address the accounting for sustainability reporting. It doesn't do anything kind of in that realm because those topics are beyond the FASB's mission. We're focused on financial reporting. But in this case, entities are buying and selling these environmental credits. So there is a financial reporting transaction that needs accounted for. So that's what we're really focusing on here. So the guidance defines the types of credits that are included in the scope of the project. That'll include things like renewable energy credits, renewable identification numbers, carbon offset type things. So the kind of characteristic things will be included in the scope of the credit side. At a high level, the guidance requires an entity to account for the credits based on how it intends to use those credits. So credits that an entity intends to use for voluntary purposes to meet a net zero commitment or some other thing like that the cost of those credits will be expensed. And then for a credit that an entity is either intending to sell or use to offset an obligation, those will be recorded on the balance sheet, and depending on whether it's going to be sold or used to settle an obligation, it may or may not be impaired, tested for impairment. On the liability side, an entity will recognize a liability under this guidance when it has an enforceable obligation resulting from a regulatory compliance program. So that's like an existing governmental program that's imposing a liability that can be settled with these credits. Something like a commitment or a net zero agreement or something like that would not be in the scope of the obligation side of this guidance. And that liability, if it exists, would be measured in two pieces, a funded and unfunded portion. We referred to this as a linked measurement model. So the funded portion is linked to the credits that an entity has that it would use to settle that obligation. So if the entity has the obligation and the credits, they would be measured at the same amount and not remeasured. And then any remaining portion of the obligation we refer to as the unfunded portion, and that would be measured at the fair value of the credits needed to settle that obligation. The proposed update, when we exposed it, I think it was in 2024, included fairly extensive disclosure requirements for these types of arrangements. And this was the source of a lot of comment letter feedback and kind of discussion and redeliberations. I think this is kind of one of the bigger changes that the board ended up making in the redeliberations process for this guidance. So the disclosures are required for annual periods. And then we've got some quantitative disclosures like the amount of environmental credits recognized as assets and expenses, and a disclosure about the change in an entity's intended use of those credits. As I was mentioning, that affects the accounting for the asset side. But there were a few disclosures included in the proposed guidance that the board decided not to finalize. Significant holdings disclosures, some income statement disclosures about total expenses and revenue from the sales of credits and things like that. So trying to right size that disclosure package for these types of arrangements. We're looking forward to providing final guidance in this area. Hope it provides helpful clarity for entities that enter into these types of transactions. Happy to chat about any questions or any details that folks have on this. Yeah.
I was curious for the environmental credits, how common are impairments? And is that a challenging measurement activity?
I do think the value of these things can change. I don't know that the population of credits that'll be tested for impairment is a population that is where an entity intends to sell it, essentially, to use it for trading purposes, but it's not kind of in the voluntary, probable of being used for its own internal purposes and not probable of being used to settle an obligation. So that's kind of a more limited subset, I think, of the types of activities. Broadly speaking, when we were conducting outreach and working through this project, we heard that people that are buying these credits tend to know what they're planning to do with the credits, which is part of how the board got comfortable with that intent-based model. There's also a fair value option for I saw Christine's tag go up and I was like, I'm getting there. There's also a fair value option available for entities for that slice of like, if you intend to be trading these credits, which reflects that type of usage in the measurement, but that's an optional measurement. Other questions, comments on this? Okay. Moving right along. The next, I'd like to cover our project on the accounting for government grants. We've discussed this with PMAC a couple of times. Most recently, this was in June of 2024 in our meeting with the PCC. We got great feedback from you all as part of that discussion. Broadly speaking, the board took on a project on government grants because we heard feedback from stakeholders that providing guidance in this area could improve consistency, in part by reducing the number of models that are applied by analogy today, because there's no guidance today on government grants. Entities analogize to a wide swath of different pieces of guidance here. And when entities are applying that guidance by analogy, it may be applied inconsistently or kind of lead to more diversity in practice. So to develop this guidance, the board sought to leverage IAS 20. And I do emphasize leverage because the board made a number of changes to the guidance in IAS 20 to make it more workable and to try and make it more clear. IAS 20 is a pretty old standard. It is analogized to in practice today. So that was part of the reason that the board selected that as a starting point, but definitely rooms to make some improvements there. The guidance includes a discussion of what is a government grant, a transfer of a monetary asset or a tangible non-monetary asset from a government to a business entity. We've got some more clarifications on what's included in that scope or not, as well as some specific exceptions. That was the source of a fair bit of comment letter feedback when we exposed this project. But we've got that discussion. Then the guidance separates the accounting for a government grant into two types, a grant related to an asset and a grant related to income. Broadly, a government grant is recognized not until it is both probable that the business entity will comply with the conditions attached to the grant and probable that the grant will be received. And then also the recognition criteria related to that type of grant have to be met, whether it's an asset grant or an income grant. A grant related to income is recognized when it's probable that an entity will comply with the conditions, receive it, and then it's recognized kind of over the period to which the cost to which the grant relates are incurred. For a grant related to an asset, there are two potential recognition approaches, the cost accumulation approach and the deferred income approach. The cost accumulation approach recognizes the grant as part of the cost basis of the asset, and the deferred income approach recognizes that as a separate item. Throughout the project, we did get some feedback on kind of the model, the use of IAS 20, the kind of some of the different options, like two different options for accounting for a grant related to an asset. And the board ended up concluding that while there are some of this optionality present in this guidance, in total, it will limit the amount of models applied by analogy and kind of improve the consistency in that perspective and provide some better starting point for practice to reduce some of that diversity in practice. So we're looking forward to issuing the final guidance in this area, hopefully by the end of this year. I'm happy to talk about any questions about government grants. Okay. The next item to mention is the guidance on PIK dividends, paid in kind dividends. So this was an exposure draft earlier this fall. This is another EITF project. The EITF added this project to its agenda kind of at the beginning of this year. I actually don't think we've talked to PMAC about this, but Lucy and Alicia can correct me if that's not the case. This is situations where an entity pays a dividend on preferred stock with like additional shares of that same instrument, like by increasing the liquidation preference. So we call that paid in kind dividends. And there was diversity in practice about how to measure those dividends. So
hey,
the
Stacey.
EITF's recommend.
How are you?
The EITF. I think we've
Stephen,
got.
Oh, no, I was just listening to something.
Stephen, can you please go on mute?
Okay. The EITF's recommendation was that these PIK dividends should be measured on the basis of the PIK dividend rate that's stated in the preferred stock agreement. So like the preferred stock agreement would state that the PIK dividends are calculated by multiplying this PIK dividend rate by the liquidation value of the preferred stock outstanding. And that's the EITF's recommendation and the board's decision was that that's the measurement that would be used. That's really it. This guidance is pretty straightforward. We didn't end up adding disclosures. We were seeking to address the diversity in that measurement. And so it's pretty narrow in that respect. The comment period for this closed last month. We're working our way through the feedback and hoping to bring that back to the board to move towards a final standard shortly. Questions, concerns on that one? Okay. Last but not least is our guidance on hedge accounting improvements. Everyone loves to talk about hedge accounting, especially at 9:15 in the morning. So this is a final update that we're expecting to issue this quarter. It addresses like a collection of practice issues related to hedge accounting. I actually don't think we've discussed this one with PMAC in the past either. But I'll briefly say these issues arose for a couple of reasons. So we did a significant update to the hedging guidance in 2017. And in a few places, the board's intent for those improvements wasn't fully realized. And the board wanted to see if they could kind of revisit a few of those issues to help make sure that practice was able to apply the intended improvements in this guidance. This had been a proposed update in 2019, seeking that same goal. And then some of these issues are essentially continuations from that. The other changes that some of these relate to kind of the global reference rate reform initiative. A few of these changes were needed because of kind of the ongoing move away from LIBOR and so on. And maybe in the interest of time, I'll just focus on, there's an issue in this collection on hedging forecasted interest payments on choose your rate debt instruments. So this is variable rate debt instruments with contractual terms that permit the borrower to change the interest rate, widely called choose your rate debt instruments. This is a common feature and a pretty pervasive strategy for hedging for these instruments. And what we're seeking to do here is kind of create a more operable model for how that hedge accounting can be applied to those instruments. There's 4 others. I'm out of time, so I'm not going to go through them in detail. But if you have any questions about the hedge accounting guidance or anything else that we've covered, happy to talk about it. It looks like Rich wants to weigh in.
Not on hedge accounting guidance. So I just wanted to make a comment. So Nellie just walked you through 5 projects. I think in the past we've talked about numerous standards that we've just completed as the FASB. So think income taxes, disaggregation, income statement expenses, segments companies just adopted, software. And the point I want to make is while that's what some might say a large volume of standard setting, one thing that we're very careful with, and we spend a lot of time as a board with, is determining effective dates. Recognizing that we need preparers to be able to successfully adopt these standards for them to provide relevant information to investors. So we are constantly challenging ourselves as to how many entities will have to adopt these. Some of these will not be applicable to all entities. Are they viewed as improving information for investors, removing unnecessary costs and complexity? And all that goes into selecting effective dates. I do think one of the most valuable things we get out of groups like this is understanding not only the urgency of the standard setting, but actually the cost and effort that'll go along with adopting those standards. So I do just want to mention that is a key part of that. And sometimes when we go through these long lists, it just sounds like, oh, look at all this stuff that's coming out. But there is an approach there, and an orderly approach that we as a board really spend quite a bit of time on.
Arush?
Sorry, I just had a quick question about accounting for government grants. Sorry to take you back. About the scope, I've seen, if I'm not wrong, like some companies will use transferable tax credits. They were accounting for them similar to government grants. Is that included in the scope of this ASU?
That's a great question. Transferable tax credits are not directly in the scope of this ASU because we're limited to monetary assets and tangible non-monetary assets, and kind of the tax benefits are excluded. Our understanding for transferable tax credits is that in practice, entities either account for them under 740, like with their tax, other tax benefits and tax provisions, or analogize to government grant accounting. I don't think the board intended to preclude either of those. We have gotten some feedback, including in the agenda consultation, which we'll talk about next, that transferable tax credits might be worth the board considering separately. And as part of the discussion in the project on government grants, I think the board was thinking probably better to address the accounting for those separately rather than specify how they should be accounted for as part of this project.
I see. Okay, that's helpful. Thank you.
Any other questions or observations about the topics that Nellie covered? No? Okay. So thank you, Nellie. Appreciate that. So we're going to move on to sort of the other end of the spectrum in terms of areas that the board may look to address in the future. And before I introduce the team, I just want to emphasize that what we're really looking to get out of this session, given the number of topical areas that were included in the agenda consultation, ITC and the team's going to walk you through that, is really any additional input that you have on the stakeholder feedback and the suggested solutions that were received. And I know we shared a copy of the board meeting handout, which had a lot of different topics on it. To facilitate that, the team's going to walk through each of the 8 chapters. Which provide each chapter has multiple topics. And so we'll pause for input on each of those chapters as we go through. But if there's topics that don't seem to fit nicely in a particular chapter or that may kind of overlap in chapters, feel free to raise those. Also, if there's chapters where you don't have a lot of feedback, that's okay too. But we wanted to at least provide some structure to walk through this. Also, just one other thing before I turn it over that I want to emphasize is that this is really the first bite of the apple. To the extent that the board does decide to add projects in the area and reaches and some conclusions on initial deliberations, I'm sure that there will be other opportunities to talk in more depth about some of those potential solutions. And as Rich mentioned, some of the anticipated and expected costs of applying those solutions, as well as the expected benefits to investors. So with that, I'd like to introduce the project team. We have Erica Friend and Tiffany Wiskowski. So Tiffany's going to go ahead and start us off.
Thanks, Alicia. So back in October of 2024, we met with PMAC to gather information on what topics should be included in the ITC. And if you recall, we started this process about a year ago because we saw that the projects on the technical agenda, many of them were going to be going to final, as Nellie just walked us through. So that discussion was part of some broader outreach that we did during the second half of 2024. And the feedback that we got became the content that was included in the agenda consultation invitation to comment, or ITC as we'll call it today, that we issued in January. That document was out for comment period through the end of June of this year. And if we move to the next slide, this will highlight the feedback that we got as related to the agenda consultation and the percentage of total respondents that identified topics as low or top priority. There was a wide range of perspectives across industries. Thank you. There was a wide range of perspectives across industries. Some topics were identified as top or low priority. Other stakeholders identified topics as neutral, and the feedback, even if it was identified as top priority, was often very diverse in the type of feedback and how the board should address the issues within that topic. So, for example, risk management and hedge accounting and outdated disclosures were identified as top priority, but stakeholders provided numerous suggestions on how the board could address the issues within those topics. So if we move to the next slide, this will give you a breakdown of how investors, preparers, and practitioners identify topics. And one interesting thing on this slide is that there is no overlap in topics. So in summary, investors and investor advocate groups mostly identify topics related to enhancing financial reporting information, where preparers and practitioners primarily identify topics related to making targeted improvements to GAAP to reduce unnecessary costs and complexity. So if we move to the next slide, this is going to be the phase that Alicia just sort of talked us through. We're going to go chapter by chapter, and we'll pause at the end of each chapter to get feedback on that topic. So top and low priority, I think, are kind of self-explanatory, but neutral indicates that the stakeholder didn't identify as top or low, but was open to standard setting if this was an area that the board wanted to address. So prior to today's meeting, we also provided you with a copy of the handout that we used as part of the October board meeting, where myself and the team reported out a summary of all the feedback that we received. So Erica and I will touch on a few observations on each slide. So we won't go through each topic in detail, but we'll highlight topics that PMAC members identified at the May meeting. So if we start off here with chapter 1, equity method received the highest volume of feedback within this chapter, and stakeholders provided mixed views on whether this topic should be addressed by the board and how it should be addressed. At yesterday's board meeting, the board did add a project to the technical agenda on improving the operability of the accounting for equity method investments. The board decided that the scope of the project should be to address the accounting for equity method investments in partnerships that are required to use equity method accounting based on the meeting for certain quantitative thresholds of influence, but where the investor does not have the ability to exercise significant influence. They also, as part of the project and the technical agenda that was added yesterday, they also noted that the team will explore ways to clarify the equity method and ways to clarify the accounting for equity method investors and non-real estate entities as it relates to the earnings for investees with complex allocation structures. At that same board meeting yesterday, the board decided not to add a project at this time on the proportional amortization method, which is a common suggestion that stakeholders had related to the accounting for renewable energy partnerships, which was also included in topic 1. And the board noted that the topic was either not pervasive at this time or the potential solutions were not cost beneficial. Also in this chapter, the definition of common control received mixed feedback. Some stakeholders noted that common control is not identified throughout the codification, but it is widely used, which results in diversity in practice, where others noted there was sufficient guidance. And then finally, just to round out another topic in here, the interaction of consolidation, guidance, and other transactions, which is the third topic listed here on the slide. This also received frequent feedback from stakeholders, primarily related to resolving differences between business combinations and asset acquisition guidance. With that brief background, we'll open it up for questions.
Great, thanks, Tiffany. So certainly open to hear feedback from members on any of these topics or any other topics in chapter 1. Greg?
Yeah, as I was going through the list, the only thought I had was definition of a business, and I don't know that we've ever reflected it or talked about before, but sometimes it seems like there is a non-business and it ends up being a Ponzi scheme. And I know we've never gone into anything like that, but you know, a lot of times when we hear after the fact that something was going on, a number of intellectuals say, yeah, that wasn't a business. This was something else. But we've been accounting for it for so long, and auditors have been auditing that for so long and assuming it's a business, but never looking at the end of the rainbow. Is there a pot of gold there or not? And I was just wondering if that ever came up in your thoughts or discussions or anything along that line.
Do you want to go first?
Sure. Happy to respond to that. So that didn't necessarily come up in here. The board did in 2017 narrowed the definition of a business so that more are qualifying really as assets or groups of assets rather than businesses. So I think that's some of the feedback we heard in here. Some of the feedback we heard in there was also what Tiffany said, the interaction between business combinations and asset acquisition and the pressure there because of the definition of a business definition moved, the line moved. So that's what we've heard there.
Thanks, Erica. Fred?
Yeah.
Are you trying to get at the fact that there's a lot of businesses that aren't operating companies, that they're just pools of assets, and then we call them businesses and they're public companies and in some cases? Or are you talking about something a little different than the fact that there's businesses that aren't necessarily operating?
More along the lines of founders maybe who get together and pool assets together and create what looks like a business, but there isn't any end to it. Almost like startups that raise lots and lots of money and millions of dollars, and some of them do go public, but there's no end in sight when they'll ever have a profit or be what I call a business end. And you know, it's a lot of subjectiveness, I think, to it, but it's more along that line. that I'm thinking about. I'm not seeing a lot, but it just seems as a culture, we push entrepreneurialism, and more are coming out of schools with the thought of let's start a business and let me go find a problem. I'm going to solve this problem, but really, is there a problem out there? I've got a solution, but no problem. And they're in business and they have employees and they're raising money and they're receiving, liabilities and debt and things of that nature that just keeps on building up.
What would be an example?
Sorry, Rich?
Yeah, maybe just a couple of comments. One, I think as a standard setter, we never decide what people do with their money, right? That's decisions people make. Our whole objective is to give them objective information to make that evaluation. Where we seem to hear about the definition of a business or not is because we have two distinct accounting models that come into play. And so that tends to fall into our purview. Occasionally the issue, and I think the board dealt with this back in 2017 as was referred to previously, is what are the essential elements to be a business for accounting purposes? And that issue on, can you have a pre-revenue entity be a business for accounting purposes, certainly comes into play. And that's something that the board's had different views on over the years. I think that that's certainly in our purview. As far as should someone put their money in something or not, probably outside of ours. But if there's anything we can do to make better portray the economics of a transaction, I think that's really where we would come in.
Makes sense.
Randy?
Yeah. On the equity method accounting project, I guess the good news is my comments will be more limited because it sounds like a lot of the things that I would have said are already incorporated in that project. One of the things that I wasn't sure whether was in that project or not is there was a lot of discussion about further limiting the number of entities that followed equity method of accounting and moving to more of a equity security ASC 321 approach. Is that somewhere embedded in that project, or is that kind of off the table? Or
yeah, great question. That is a piece of what the board is looking at in this project. So essentially acknowledging you've got what we call quote unquote true equity method investments, where an entity clearly has significant influence. We've got qualitative indicators of that. There are this population of entities that are required to apply the equity method, but kind of below that threshold. So in between equity security accounting and significant influence, quote unquote true. What the board is doing with this project is looking at that population of entities that apply the equity method kind of in that little range, and looking at either can we adjust the scoping of what gets into the equity method or not, or can we provide a measurement alternative to look more like equity security accounting or something else. So there's a couple different ways we could address that, but we have identified exactly what you're describing as kind of the question to be addressed.
it seems to me that if depending on how far that goes, there would be a lot of opportunity to structure transactions to avoid recognition of expense in entities that otherwise would be consolidated or equity method accounting. So, but the 3 to 5% interest being equity method accounting, recognizing that it's been around for 50 years, but it doesn't always make a lot of sense.
Christine, did you want to get on that one?
Yeah, I was just going to provide some thoughts, Randy. So, I think you nailed the issue because when there really is significant influence, it's really critical that those be accounted for under the equity method. We've heard repeatedly over many, many years from investors that the equity method of accounting provides them with decision useful information. So I think this is a project about scoping and making sure that the right group is in equity method and ones that shouldn't be there aren't. But I think that it is going to be tricky for us to figure out, what changes need to be made to get there. And it's probably going to be more judgment based. It's the bright lines that get us into trouble, I think.
Randy?
Yeah, and to that point on the bright lines, when you start thinking about the structure of particularly LLCs, et cetera, the 20% threshold doesn't always make sense either, because you could have significant economic interest with absolutely no control. So to me, it all kind of ties together with the consolidation project of trying to figure out what really is control, what really is significant influence, and the economic interest may not necessarily be equivalent to the control or influence.
Thanks, Randy. Marcel?
Just on the equity method, I know one of the things that I said is just simplification of some of the accounting, especially where we have very complex capital structures in businesses, and you tend to use the hypothetical book value liquidation method in your accounting. Sometimes you tend to get really weird answers in the application of that methodology. Thinking about situations where you have different classes of shares and preferences and how money gets distributed, and when an entity issues new shares within a certain classification and you participate in both classes or more, you can suddenly have a shift in how money is getting allocated to you because of liquidation preferences at multiples in excess of others. And you start recognizing this income in your P&L that is really not based on anything that changed, just purely on your ranking where you sit within the structure. So you tend to get really weird answers in that specific sort of circumstance. And it's complex to do these things because you don't always have information. You never majority shareholder, you get some financial data, but the consequences of the application model can be really weird. Now, sort of flows out, but I don't know how you solve it, to be honest with you. It's not that simple.
Hillary?
Marcel, just a quick question. Are you seeing that in instances where where they're hitting that significant influence, that 20%, or other qualitative characteristics of significant influence? Or are the situations you're seeing more in the instances where it's kind of below that threshold? You might be in the 3 to 5%, for example.
So in our specific example, we actually have significant influence. We're in that 20 to 50% range. And we have board members and all those things. We're just below that, but we're always significant influence because of our board holdings. And then we've moved into the 20%. But it's when they've issued a new class of shares sitting at the top of the stack. It's got a 3 times, and it's normally when entities getting into a more distressed situation, we start asking a lot of other questions around that and valuation, but you can get very disproportionate recognition, even if you make adjustments to the value of the entity, sort of impairing some of the value. But
Thank you, Marcel. Bob?
Yeah, I agree with Marcel. These arrangements are getting more and more complex from an equity structure standpoint. So it is a little hard to have these tests around what defines a significant influence. But the question I want to ask, maybe more Nelly, since it sounds like you're in the middle of all this, right? So I saw in the commentary, right, there's a question mark. Do you pick up your share of the net income, or do you move more to a model where you pick up the actual cash distribution or dividends up as the income in the owner, right? So I think that's a very worthwhile exercise, right, in terms of how people value these businesses, right? Is this really share net income really the right measurement to be picking up in the owner's?
And are you thinking about these entities with complex allocation structures, or is that more
just in general? I mean, even ones that are simple ones, right? It's like, is the share of net income really the right measurement? Because lenders look at what pure cash coming up, right? They ignore whatever GAAP earnings you pick up. And then like kind of the second thing I always think about is where in the owner's income statement that equity income comes in, right? You know, it may be an equity arrangement that's sort of integral to their operation. So it's like almost like a supplier arrangement. So does it sit in cost of sales? Where should it really sit? So I don't know if that's all part of the project.
Yeah. First of all, it's not just me. There's a whole team. I just am the one who is here. They get the credit for this.
You're still one in the room.
I'm the mouthpiece only. We got a lot of feedback on the equity method, and the equity method is a very rich topic with a lot of potential questions. And you can think about, again, ways to improve the mechanics of the equity method. The IASB is doing a project kind of in that direction at the moment. For what the board agreed to add to their agenda for now, it's not as much focused on the mechanics of the equity method for what, plain vanilla, bad phrase, but plain vanilla type investments like that. We're more thinking about both this significant influence, different thresholds and levels, and then about these entities with more complex allocation structures and maybe providing a little bit of clarity around that. The project to think about kind of the mechanics of the equity method and what is it meant to represent and what is the best way to think about it could, really go on for quite some time. So there's a lot there, and we got a lot of that feedback. It's not something the board is taking on at this time.
Thanks, Sally. Marcel?
And just to add to that, I mean, two things I'm going to say is that from my perspective is that you can do a fair value option, which probably takes away a lot of that complexity, but probably adds more complexity in the inability to value. And then how do you allocate your fair value in a structure that's really complicated? So, I mean, that might be one answer of how you address it. And then the second thing is probably a lot of companies, the way that they talk about their earnings, especially if you're public, equity method is not that important when you sort of talk about your performance. So maybe it's not, but it is complex, time consuming.
Rich and then Christine?
Yeah, I do think one of the things that'll be interesting is we certainly heard quite a bit of support for the equity method of accounting and the transparency that provides related to those investments in the investor's financial statements. But you mentioned the fair value option. That's a decision the board made quite a while ago, and that actually takes away a lot of that earnings benefit that you see through the financial statements. And I'll be curious as our board works through this, if we're all in on the equity method, how do we feel about that fair value option still? And do we think that makes sense when something's not publicly traded, for example?
Christine?
Yeah, I wanted to just reiterate again that, we've done a lot of outreach over many years on the decision usefulness of the equity method of accounting. And what we hear from investors is that they don't see the world the same way preparers, practitioners, and their advocacy groups see the decision usefulness of the equity method of accounting when it's being applied to actual investments where there is significant influence. So, when we speak directly to investors, they're not saying, I want fair value. In fact, they've told us they don't want fair value because the volatility in the fair value is not reflective of what they view the underlying cash flows to be, because it's not going to be sold in any time soon, given the relationships. And they also don't want cost, because cost gives them no information. So when you look at the alternatives, it may not be perfect, but from an investor's perspective, it still gives a lot of transparency. And so, just speaking from my point of view as a board member, when it comes to usefulness, I personally would listen more to what investors have to say, frankly, than the practitioners and the preparers and their advocacy groups, just like I will listen to them more when it comes to thinking about what the costs are, because I think each group has better insight into those aspects.
And Christine, I just want to add is I would agree with you. Personally, I'm not a big advocate of the fair value method, and we decided not to follow that, even with the complexity, because it just didn't feel right. And I do the allocation model personally, makes a lot of sense. So, but you get just weird answers, and those are difficult to explain sometimes to investors when you have those situations, but I would agree with you.
Great. Rocky?
So just want to add to Rich's comment. I think with fair value election option, if you elect for entities that are private, the complexity it adds to the valuation process on an interim basis for public reporting entities, and how you're getting that information and how that subjective assessments are reviewed by your auditors, it just creates a whole different layer of complexity, which you traditionally don't see that much in other in non-fair value election option.
Thanks, Rocky. Jason?
I think I'll just point out though, right, like in the private equity industry, everything is fair valued and they have processes to auditors value fair value. Let's not forget that as well.
I've really appreciated the input on the equity method. And I think we started off with a firecracker given our board meeting yesterday. So just appreciate everyone sharing their views on this, and it will continue to evolve. Before we move to chapter 2, was there anything else on chapter 1 on the topics that the team covered or otherwise? Okay, let's go to chapter 2.
All right, thank you. All right, moving on to chapter 2. For chapter 2, the topics on risk management, hedge accounting, alternative funding arrangements, and distinguishing liabilities from equity were among the top stakeholder feedback that we received. For these topics, stakeholders provided mixed views on how the board should address them. More specifically, for distinguishing liabilities from equities, stakeholders provided feedback about targeted improvements the board could consider in order to reduce costs and complexities with applying the current guidance today. For example, a large number of stakeholders stated that they would support accounting for more contracts indexed to an entity's own equity as equity. For risk management and hedge accounting, stakeholders provided a variety of suggestions, from narrow targeted improvements to broader suggestions such as holistically revisiting the hedge accounting model. Alternative funding arrangements was primarily identified as a priority by stakeholders that would like the board to address the accounting for royalty monetization in the pharmaceutical industries. With that, we'll open it up for questions or feedback.
Great. Anyone want to start us off on any of the topics that are in chapter 2? Any questions, observations, feedback? Randy?
I'm not sure if it's really within the definition of a derivative or distinguishing liabilities from equity, but anything that can be done to simplify the accounting for complex debt arrangements, I think would be helpful. It's just a lot of complexity in trying to figure out what the embedded features are, which ones have to be bifurcated, which ones don't, and then the evaluation of those embedded features once you get there. Particularly when things ultimately will settle in equity, issuance of equity. It just creates a lot of complexity. I'm not sure it provides a lot of information, but maybe it does to somebody.
Thanks, Randy. Hillary?
And Randy, I think that's a good point. And I think it's part of the distinguishing liabilities from equity project. Because if you think about it, we have a scope exception for certain features. And I think the question here is whether or not enough instruments are actually meeting that scope exception. And, I think that's something that we're looking at with regards to especially features, indexation features that are very common in these types of arrangements, and really looking to make sure that it matches up with kind of the economics of the transaction, right? We see instances where there are indexation features that can only be triggered upon a change in control or an IPO, something like that, that are really driving the accounting answer, causing these things to be liabilities on day one, right? And I think from an investor perspective, we've heard some feedback of, well, until it happens, maybe it doesn't need to be a liability, right? Maybe that's something that we should be thinking about. So that's certainly something I think that the staff is planning to come back and talk to the board about. But I think that parlays into the, whether it meets the definition of a derivative, whether you have to bifurcate it. Certainly a complex area, and I'm not sure that this project will address all of those, concerns. But certainly I think it would go pretty far for addressing some of the major issues that are out there.
Great. Any other questions, thoughts, or observations on financial instruments chapter? Okay. Let's move to chapter 3.
All right. Stakeholders' top priority in chapter 3 was the accounting for crypto assets beyond the last project, such as expanding the scope of subtopic 35060 to include wrap tokens and provide derecognition guidance. Rich did add a project to the research agenda after the issuance of the ITC that is exploring targeted improvements to the accounting for certain digital assets, such as crypto lending. When we get to chapter 4, I'll provide you an update on the topic related to the definition of cash equivalents and its interaction with stable coins. Also here within chapter 3, many stakeholders identified goodwill as a low priority, but preparers primarily identified it as a top priority. And those that identified goodwill as a top priority noted operational complexities and challenges with the current accounting model, and they'd be in favor of permitting amortization or immediate expensing of goodwill. With that, what questions or comments do we have on chapter 3?
Any observations, questions, thoughts on intangibles?
Hi, this is Shubho here. I have a observation here on the crypto assets part of this. Certain companies that we've invested in look at the change in fair value of crypto assets as something that actually affects their operating expenses. And it's it can swing around, as we know, pretty dramatically from quarter to quarter. Is this up for a conversation as to where this should be actually involved and included, and instead of looking at it as a change in fair value that goes into OpEx, given a lot of this crypto is Bitcoin based, look at potentially including this in the cash and cash equivalents, because really Bitcoin has now become a substitute for currency.
Rich?
Yeah, and I don't want to jump ahead to the team because I think you're going to get to this in the next slide. The standard setting we've done on let's call it digital assets where there's no claim to cash has fallen into the intangibles area, and that's where that is. Now, as far as whether if someone's recording a gain and loss on that, where they put it in their income statement, that's probably going to depend on their business model. Are they an investment company? Are they a broker dealer? Are they a commercial entity? Is it their primary business? Is it their secondary business? And I won't get ahead of the team, but the issue on cash equivalents tends to deal with financial assets where people have a claim to cash under an instrument, and then depending on the current definition of cash equivalents, does it meet it or not? Well, I've heard it would be a lot of change to our guidance to say something that simply because it is liquid would be a cash equivalent. That would be a dramatic change in both the definition of cash equivalents, because then there's a lot of things that could be a cash equivalent then, including gold, including any form of commodity. And I'm not, it certainly doesn't work today, and I haven't necessarily heard a lot of interest in that to date.
Urush?
Yeah, I just had a comment about the goodwill topic. There's been a lot of talk from academics and practitioners, and I guess standard setters as well, that since we switched to an impairment-only model, the goodwill balances have sort of run away, and the discretion is what is reducing the rate of impairments. There is a new accounting paper that I believe is almost published from some very established authors, which does a really good job of comparing how the goodwill balances have evolved, and it compares them to finite life intangibles, a lot of time for the same firms. And it actually provides some different takeaways. It's, the common concerns that the goodwill balances have run away, maybe that's not necessarily the case. So if the team is interested, I'm happy to send that paper along.
Thank you. Jason?
Yeah, just for what it's worth, I don't know if they comment or not, but I've had a couple clients mention to me, knowing I'm on this, say, hey, we would be in favor of bringing back amortization of goodwill as opposed to just going to the straight impairment model.
Michelle?
Yeah, I think along those lines, being a preparer, for my team, having goodwill and having done a number of acquisitions where, we're doing an acquihire or something and maybe buying a piece of technology. That goodwill is just sitting there. It just creates onus to have to look at it every year. And I'd be in favor of amortizing it. And I don't think it's meaningful for, curious what investors think. I think you look at that line item and you're like, oh, okay, they bought something a while ago. Not sure it's meaningful.
Thank you. Christine?
So this is music to my ears because I've been a strong proponent of amortization for a very long time. But that said, where we end up stumbling in this one generally is on transition. So on all that goodwill that's sitting on the books that we were just talking about, that's been growing and growing and growing, if it would be under whatever time period, is ultimately identified, the catch-up adjustment would go directly against equity. Are your clients equally comfortable with that catch-up adjustment for past goodwill that has not been amortized?
I don't know. I didn't ask that question, so I can't comment.
Okay.
Marcel?
I'm probably, as a preparer, someone that's very contrary to a lot of other preparers that actually like the model the way it is at the moment, but with a suggestion that I think would be helpful. And I know what the answer is going to be to what I'm proposing, but because people would say there's already a qualitative method in place to evaluate, but the practice comes in and why people want to amortize or get rid of goodwill is the cost and effort involved in doing the annual impairment testing. It takes a lot. We do over 20 annual impairment testing because of all our business units that we have and reporting units in our company. So it's extensive when we do it internally. So I definitely share that effort, or sort of view. But I think if the model can be changed where for an annual impairment test, instead of being required, you go to a triggered kind of test that you have at the moment. Similar to we have an interim impairment test, would save a lot of cost because some of those reporting units of us are clearly not even close to being impaired, no risk. The problem that you have, because of the way that practitioners or auditors apply the review of the qualitative impairment model, you end up spending way more time doing the qualitative methodology to support goodwill not being impaired, and the view and the subjectivity to some of the assumptions and views that you need to do in the memos that you write, that it makes it almost impractical to a large extent to apply that. And as a company, we prefer to skip that step one of the model and go straight to quantitative impairment. Because the cost is less, it's easier to get it through audit. But if you get to just a trigger, we've got a business unit that's got 500-600% cushion, but we test it every single year. And there's clearly not a trigger within that, something that's acquired 60 years ago. But we still have to go through the effort. But if you do the similar to the interim impairment triggers, apply that in a model, it would immediately scope that business unit out of testing and save cost, if that can be brought into place or evaluated. So I'm not a proponent of amortization and writing off. I don't think it makes sense if you just spend a ton of money on something and you immediately get rid of it, but that's just my view. But I think that there's slight improvement that can be made in a model that can benefit people in doing less impairments at the end of the year or when they do it.
Thanks, Marcel. Jared?
I think Marcel's trigger comments are interesting, but to answer Christine's question on how investors handle goodwill, yes, we generally view it as a sunk cost and is largely ignored, which is then my problem with the amortization model, because that's just gonna be one more adjustment that we're gonna be making. Don't love it when we're making adjustments to GAAP. So that would be my one issue with the amortization model.
Thanks, Jared. Randy?
Yeah, I'm probably in Christine's camp of amortization, partly because I actually think goodwill is a wasting asset, and it's inconsistent to not capitalize internally developed goodwill, but to capitalize and then keep purchase goodwill on the books forever. The question of how would clients feel about, or how would companies feel about that big catch-up adjustment going direct to equity? I don't know, but I suspect a lot of them would love it because then that amortization would never go through the income statement at all. We've actually had some private companies ask whether they could just write goodwill off on day one, because basically just taking a 1 day useful life for goodwill because they find it meaningless.
Thanks, Randy. Michelle?
Yeah, I think same page, Randy. I'd like, if there's a way to figure out how to just get it all off the books and everybody does it at one point in time and it's known as an adjustment. I mean, I think that's how you could look at what's existing. I'm sympathetic to your probably writing 20 memos for, all of the different acquisitions. We're starting to get there too. And it's painful and no one really cares about it much. And so I think you'd have to think about, on day one, to your point, I think companies were stuck in our head. Well, we didn't overpay. We're getting this goodwill for it. And it's like, well, but how are we looking at it 3 years down the road? We're doing this big impairment test and deciding, So I think that, we'll have to, it's a change in mindset that we'll have to think through, but I think it'll make the accounting much more simple and something that's just not meaningful for folks.
My 2 cents following Michelle is I totally agree. And I'd actually left the last PMAC meeting with the conclusion that the users and investors don't care about goodwill because they'd made it clear in the last meeting that they don't include it in their models, right? And I think, someone had just said that they strip it out of their models. So it's not decision useful. It's not useful information. And given the challenges with the existing impairment models, I'm definitely a fan of amortizing off the books.
Thanks, Jeffrey. Rich?
Yeah, just curious for the people who don't like goodwill, if an option was given to write goodwill off day one, do you think entities who chose to do that would be viewed as a higher quality than entities that didn't?
Go ahead, Michelle.
Yeah, I mean, I think as long as the choice is interesting, right? Because then you have disparity in sort of what things look like. But given the fact that people don't care about it, I mean, I think your point is great that it's not in anyone's model. It's not, but I think it would become, I think we would do it as a company.
Marcel and then Fred.
And Michelle and Jeff obviously I'm in a different camp of not wanting to write it off, but so there's a value from a acquisition perspective where it does become a measure of the success of a company and acquiring other entities. It's a signal out there when you make acquisitions, you constantly impair them. Somewhere in your business model, you do something really terribly wrong. And investors can see that if you constantly have impairment after impairment after impairment, it's a reflection of your management, the choices that you make. And investors should bake that into how they acquire your shares or not. That's just my personal view. So I do think goodwill does serve a purpose. I know there's a lot of internally generated goodwill that doesn't make its way onto the balance sheet. I get that. I think last time I mentioned there's like some international accounting allows you to do this remeasurement of assets and things to get sort of, that's not a part of the US model where you can get it closer. But, if you spend money on something, at some point in time you decided to spend that, it has value to you. The hope is when you make that acquisition, I've never read a board memo that went to our board on an acquisition where you don't see positive attributes being allocated to that specific acquisition, why people make it, and with the whole view that this should accrete in time to make it better. And every company talks about synergies when they make these, or how it's going to help some of your other products. So the goodwill should accrete in a good environment where your acquisition works out the way that you'd plan to do it. And the fact that it doesn't, there's many things that can cause that, but if you continuously have that, then it should indicate that management constantly make incorrect views or assumptions about acquisitions and should be a reflection to the market of who the people are running that company. That's my view on this. So I'm not a proponent of just writing it off.
I can respond, but I think Ryan's also is an investor and user, might have a useful comment. Maybe I should let him go first.
Ryan, do you want to jump into the conversation?
Yeah, sure. More from just a preparer perspective, though, and answering Rich's question, I don't know that I would, if it was elective, I don't know that I would consider those that chose the election versus not to be viewed as like a higher value reporting entity or high quality reporting entity. The way I also think that like the investor group that you serve from a stakeholder perspective and a preparer perspective, they would have a view on this. For my stakeholders, they don't have much consideration for goodwill impairment. It's a lagging indicator. It's not reflective of what's going to happen in the business in the future. It's what's already happened in the business. So I would say that my expectation is a lot of people would elect to impair goodwill immediately upon acquisition, just because there's not a lot of value that's granted. But I think it would be I think for high quality reporting companies, if you're trying to like identify them in that context, they would be having outreach to their shareholders and investors, which could be like varied or just a few and concentrated. But I do think that the outcome would not be dissimilar.
Ryan, I'm glad I let you go first because that's a perfect segue for the nuance. So Marcel, I agree with you, but my comment was going to be that by the time companies make the impairment, the investors have already impaired it in their models, right? It's they've already, because when they bake this into their models, they're focused on future cash flows and how it's going to accrete. And, by the time it shows up in the accounting things, the investors have long baked that in. So that goes back to my wondering how decision useful a lagging indicator of a goodwill impairment is versus just, having a reasonable amortization approach.
And they adjust it out. They adjust-
100%
yeah,
it's
so
adjusted out
It's always
anyway.
adjusted out. Well, that's what the CFO is always going to ask, or the.
And you could probably do a historical study of like what happens to share price on goodwill impairment, and probably very little, right? Because it's already been adjusted out. It's already been baked in by the Ryans of the world.
Appreciate you all sharing those perspectives. Some board members want to weigh in as well. So I've got Fred and then Sue and then Christine. So hearing some other perspectives.
So I think it's important to note we have an experiment on immediate goodwill expensing because the Swiss allow that option. And in general, at least I haven't done an extensive review, but investors generally don't like it because of the lack of comparability between companies, number one, but also because while goodwill amortization, goodwill is adjusted out of operating earnings, I don't think that means that investors don't believe that it has meaning for them in terms of valuing the companies. And so the immediate expensing, I think, has proven very problematic in Switzerland. And I think it's really along the lines of what Marcel was discussing.
Sue?
So, certainly I think when we've done this project in the past, we've heard differing views about this notion of lagging indicator. And I think your comments, Marcel, are very in par with what we've heard. I think that the thing that I always am interested in is, investors seem to have told us that they use that lagging indicator as of impairment. Is it a proxy for the success of the business combination itself? And, the ISB has a project on their agenda on business combination disclosures. And I think there's, we've kind of watched from a distance, and certainly when we have our annual education sessions, they share that information with us and what they're doing on that. I think, at least from my perspective, the natural tension is what information can you provide that is not considered to be forward-looking information? But I wonder if we were able to come up with some kind of disclosure that would help understand that success of the business combination, whether it would take the tension off of what we do on goodwill. Do we amortize or do we not?
Christine and Uraj?
So did Aruj want to go first? Because I think his hand went up before my card.
Go ahead, Aruj.
Sure. I just wanted to add one piece of observation. I mean, there's several academic studies which have shown that impairments of goodwill are value relevant. They elicit market reactions. So I see the point that yes, it reflects past and the management has moved on, but there is some news in goodwill impairments. And I think, I forget who raised this, but the point that, a manager that's constantly acquiring and then subsequently impairing the goodwill sends a signal about the quality of those acquisitions. So that's probably something, or maybe that's something that's useful to the board as they're thinking through this topic.
Christine?
Thanks. So it's interesting, this discussion around the table is very similar to the discussions that we have. So many different perspectives, which is why it makes this topic so difficult. But on the immediate expensing, the way I think about that is, the income statement serves two purposes. One is to help investors forecast future cash flows. And from, for that purpose, adding back amortization, adding back the immediate expense, adding back, if there's an impairment, I understand why an investor would do that, because the amortization is not providing you information about future cash flows, because as Jared said, it's a sunk cost. It's a past cash flow. But the other purpose of the income statement is to provide a measure of the success or failure of managers' decisions to make this investment in the first place. And the cost, the total cost, which includes goodwill, is an important part of that metric of the success or failure of income on an ongoing basis. And the problem with immediate expensing is that, it's basically just big bath accounting. It's a huge non-economic charge on day one, which then results in overstated return on assets, overstated return on equity, overstated income, understated assets for all future periods after that. And that is why I think we have heard consistently from investors, not maybe 100%, but most investors would say, yeah, I don't get that excited about goodwill. I can live with an amortization model. I can live with an impairment model. But the one thing I don't want you to do is to write it off on day one.
Okay, Marcel and Jared?
Yeah, just from my perspective, the last comment I want to make is that the information is available and people can do with it whatever they want. You know, they evaluate companies being an investor or a preparer, us as preparers. And the reason why we bring this up, and I think we're all consistent in that regardless of our view of goodwill, is the cost that it takes to do the test of the impairment. I think a lot of preparers would change the tune very quickly if the cost aspect of what it takes to sort of test this annually gets reduced materially or significantly. They wouldn't care as much about the theoretical academic sort of discussion around goodwill and where it belongs and how it should be treated. So a lot of the things that as preparers people talk about is the cost, and anything, so my suggestion is anything that can make that better and even reduce it a little bit. Anything that's a little bit is better than nothing in that. So that's really what I think it comes down for preparers and why they find different ways to justify why it should be taken or accounted for differently.
Thank you, Marcel. And Jared, and then we're going to move on to the next chapter.
You know, as I said, I've never been surprised by an impairment, but the more I think about it, it is an important signal. You know, we're not surprised, but it's also an admission of mistake. Most acquisitions are mistakes. So it is an important signal to investors, but also to management that they have to stand up and admit that they've, you know, made a bad decision, which I do think is an important thing for them to have to say for the, you know, for everyone's good.
Thanks, Jared. Okay, so with that, we're going to move to the next chapter.
All right, moving on to Chapter 4. So within Chapter 4, asset retirement obligations, or AROs, was a top priority for stakeholders, although there was some mixed feedback within there. The feedback was primarily focused on unrecognized AROs and how they should be accounted for and if they should be recorded. The definition of cash equivalents received the most amount of feedback in Chapter 4, but received mixed feedback on whether the board should change the definition. At the October 29th board meeting, the board did add a project to the technical agenda to address whether certain digital assets like stable coins may be classified as cash equivalents. The board did not make any tentative decisions at this meeting. Rather, they directed the staff to explore if examples could be developed to clarify the application of the cash equivalence definition for certain stable coins. With that, we'll open it up for feedback.
Any observations, questions, or feedback on the areas that are in Chapter 4? Yeah, we touched on stablecoins earlier. Shubu?
Yeah, hi. Just an observation on stablecoins. Yes, by definition, since they're pegged to the US dollar, I would make the case that they are a cash equivalent, and so do kind of qualify to be there. Thanks.
Fred?
What kind of safeguards do you think would be needed on that score, Subhash? I mean, if a leveraged stablecoin or something that's only partially backed, would that satisfy you, or do you think we need guardrails in terms of what would be required for a stablecoin to be considered cash equivalent?
No, it has to be fully backed, 100% backed by treasuries on the back end for it to be considered a stablecoin in the first place. And in that case, it should be considered cash. But if it's not fully backed, or if there's any risk that you can not exchange that stablecoin for pegged to that $1 or to a government security, treasury security, then it should not be considered. So I think that the litmus test becomes the kind of exchangeability, if you will, into a dollar, whatever the currency is, whatever they name it, that X coin has to be equivalent to $1, come what may.
Hillary?
And I think this is really helpful feedback. I think one other thing we've been thinking about with regards to stable coins is there are different rights and obligations, and it can be different by the holder of the stable coin, right? In certain cases, only certain holders have the ability to directly redeem, right? Others don't and are looking for kind of being able to sell it in the marketplace from a liquidity perspective. So something else to think about. I don't know when I have thought of stable coins before is having to think about from the holder perspective, right? You generally think of it from the issuer standpoint, but we're certainly seeing some of those distinct differences here, which are some of the things I think we're thinking about as well.
Thanks, Hillary. Urush?
I think this is such a interesting and fascinating topic, which is only going to get more important. I totally see value in Shubho's comment, but the question arises is then who certifies that these stable coins are backed by Treasury? Do we need a third-party certification for this?
Appreciate you raising that question. I think that's something for us to consider. Any other observations or comments on stablecoin or any of these other topics on other assets and liabilities? Okay. Do you want to move to chapter 5?
Sure. Thank you. All the topics in Chapter 5 related to retirement and other employee benefits were generally identified as low priorities. For the remeasurement of share-based payment awards, stakeholders here noted the current differences in the accounting treatment between liability and equity classified awards, that it appropriately reflects the economics of those transactions to have them differently classified. For defined benefit plans, the second topic here, stakeholders generally noted that these have been phased out over recent years and that employee stock option plans are not as pervasive. And therefore, stakeholders noted that the second and third topics on this slide should all be lower priority. And finally, on the last topic, partnership accounting, no stakeholders identified this topic as a high priority. Generally, stakeholders know that there's no significant challenges in applying the current guidance related to partnership accounting. And so with that, I'll open up any questions or feedback on the topics in Chapter 5.
Thanks, Erica. Any comments or observations, questions on this area, realizing that some of the responses, Randy, go ahead.
Yeah, given the number of low priority, I'm assuming the ESOP repurchase obligation disclosures probably are not going to result in a project. But if it does, I think there's some real challenges in the idea that companies could actually forecast a 5-year retirement repurchase obligation. In a sufficiently large number of employees, you wouldn't have an idea of how many might actuarially retire. But when you're talking about a smaller company that may only have 100 or less employees, not only knowing how many are going to retire, who is going to retire in that 5 years, how many would choose to diversify, I think that it would be a virtual impossibility for a company to determine. And there's already requirements in the standards for disclosure of the repurchase obligation in the aggregate.
Thanks, Randy. Sue?
Yeah, I appreciate that feedback, Randy. That's certainly a topic that in the private company space, the private company users, particularly the bankers, have been very, very interested in enhanced transparency. And so I appreciate your comments.
Any other comments or observations on this chapter? Okay, chapter 6.
Okay. For Chapter 6, which covers various income and expense topics, mainly related to revenue, principal versus agent considerations was the highest priority within this chapter. Stakeholders here noted that this area of GAAP continues to be challenging and that the application of the guidance in Topic 606 can be especially challenging to apply when there's multiple parties involved in the transactions. And this was mainly noted to be an emerging issue for emerging business models related to platform companies and managed healthcare companies, just to name a few that stakeholders referenced. The remaining topics within Chapter 6 were identified as low priorities. And with that background, any feedback or questions on the items in Chapter 6?
Any observations or additional input on any of these areas and looking at the feedback? Marcel?
Just on the first topic, principal versus agent commissions, and I know I was one of the people who responded that understanding it's a complex model, there's a lot of gray in the model. I don't know how you change it to make it necessarily better. There's a lot of factors in there, But I was thinking about it a little bit more. Do you get to a point in time when you look at all the factors being evaluated and you get to this 50-50 decision where you get things that, can go either way. You might have inconsistency in application, similar fact patterns between different entities. That doesn't make it very comparable. And I don't know, how do you apply a bright line test necessarily just down the line that this is a definite yes or no? It's really complex. A lot of times to comply with this guidance, and it's probably continue to always be a different aspect on how you apply it. And maybe disclosures is something that the way that you solve it, but I'm not a proponent of changing or adding to it, but I just want to highlight, you can get to situations that is great 50-50. And we've had numerous consultations with our accounting firms where they say, well, you pick which one you want to do, kind of thing. And that's probably not the answer that you want to get to ever when you do any accounting application. So.
Thanks, Marcel. Randy?
Yeah, I appreciate the complexity of the principal versus agent considerations, particularly in tri-party arrangements. I am skeptical that there can be something written that would adequately determine who the principal is and who the agent is in all of those arrangements. Everybody loves principle-based standards until they create diversity in practice. And I think anytime you have a principle-based standard, you're going to have some diversity. It's a question of whether you can live with that diversity or not. But it is a challenging area in a lot of the tri-party arrangements figuring out. So if there were, and I think a couple of respondents made the comment, more examples about how to think about the principal versus agent consideration, that might be helpful. I find examples very helpful to illustrate the application.
Thanks, Randy. Any other input from other members before we move to the next chapter? Okay, chapter 7.
Chapter 7 related to presentation disclosure of financial reporting information, with most of the feedback we received leading up to the ITC from investors on this chapter. Enhanced disclosures and outdated disclosures were the highest priority for stakeholders within Chapter 7, but you can see that there was mixed views. So enhanced disclosures was a topic that received the highest volume of feedback overall of all the topics in the ITC, but that feedback was really split between investors and preparers. While investors generally agreed that the board should enhance disclosures as a top priority, although there was a wide variety of suggestions on which exact disclosures should be enhanced, preparers, on the other hand, generally agreed that the board should not add any incremental disclosures, but rather, as related to the second topic on the slide, outdated disclosures, the board should consider reducing or eliminating certain disclosures such as derivatives or fair value measurement disclosures, which they see as outdated. As it relates to the definition of a public business entity, stakeholders were generally neutral on this priority and noted that if the board were to pursue a project, they could consider a few things. They could consider revising the definition to exclude certain entities like bond conduit obligors from the definition of a PBE. But stakeholders also identified that there were a dozen variations for the definition for public and private entity, and the board could consider eliminating some of those definitions. And so with that, any observations or questions? Back to Alicia.
Great, thanks, Erica. Any comments, observations, questions on any of the topics in this chapter? Jared?
I would just be curious about which enhanced disclosures you heard about the most from stakeholders.
I think there was a lot. So there were certain things related to tariffs. Some were just very specific transactions that investors wanted more information about, but it was a pretty diverse list. The ITC included a diverse list, and I'd say that's pretty much what we got back was a diverse list.
Randy?
A couple of quick thoughts on enhanced disclosure or maybe elimination of disclosures. I do think there might be some value in reducing the number of required disclosures in interim financial statements, just from the standpoint of the idea is the interim financial statements are new information. So I find that some of the disclosures are redundant from the annual financial statements, and I question the value of some of that. So trying to scale that back to what is actually new information changes from even some of the tables that are required, whether they have had meaningful, significant changes. I'm not sure, again, you get back to some principle-based analysis, which might create some diversity in what people disclose. But I do think that occasionally the interim disclosures get a bit onerous just from the standpoint of what's required. My favorite topic is always PBE. So I try not to repeat what I've said in the past and just let that one go.
Thanks, Randy. I have Michelle, Rouge, and then Jared.
Yeah, I think just +1 to Randy's point here. I think most of the new disclosure requirements are required at interim. And, I look at like fair value. That does not change for us as a company, like just level 1, level 2. Does anyone really care that much about level 1 versus level 2? That's a separate discussion, but quarter to quarter, it's very similar for us. I think it's almost like, oh, we just plop this in. And it's like, I think preparers are probably having the reaction of, I'm open to enhanced disclosures, but let's eliminate some things that aren't meaningful for us and aren't meaningful for the investors. And so, I think it's a good discussion to have in tandem for both of those things.
Thanks, Michelle. Aruj?
Yeah, I was, question the same spirit as Jared. What, I don't know if you can share, but I'm curious, what disclosures were considered outdated by the stakeholders? I think you mentioned fair value. I see Michelle's point for certain companies, definitely there's not much change in level 1, level 2, level 3. But you can imagine for financial institutions, how the assets are moving through those categories can become pretty important. And as a user, you want to know where those assets are sitting. So, I think the board will have to think through how do you determine what outdated disclosures are. I think it's a great project. It can add a lot of value, but not an easy problem to solve.
Hillary, did you want to?
I think just to, think about the types of things we hear feedback on, I think Michelle kind of referenced, right, the fair value disclosures and the extent of those disclosures and whether or not all of those are necessary. Certainly, I think we hear it in the derivatives and hedging space as well. So you do hear it on more of a topical basis, where maybe sometimes the disclosures are very voluminous and are not necessarily being utilized by investors to understand, right, how people are actually managing their risks. So I think that's a couple of areas where we've heard some of that more general feedback of, is there a possibility for kind of looking at those disclosures? And I think some of that can be related to, do we need to relook at the underlying accounting? And then when we relook at the underlying accounting, obviously there'll be consequential changes to the disclosures, and do we need a fresh kind of sheet of paper when thinking about that? But maybe just a couple of examples to highlight there.
Thanks, Hillary. Jared?
Michelle took my view, my comments. But as investors, I recognize we're always asking for more disclosure. So I think it's completely fair to have some horse trading, reduce some disclosure that's not useful in exchange for other enhancements. So I do think that's a worthwhile combined project.
Thanks, Jared. Any other observations from any other members on these topics in this chapter? Oh, Marcel?
I just want to add, as a quarterly preparer, one thing I realized the last time, followed quarter 2, a week and a half ago, is like going through this disclosure checklist. Like, we as preparers don't always do a good job in like eliminating things that you don't really need to disclose. It's more out of habit. You just keep it in there because it's simpler. It's part of the process and it works. And I think it's sometimes even more complicated making that evaluation. Okay, I'm going to leave this out this quarter, or every sort of, when do you bring it back in? It's just a thought that came up to me, is that it's challenging sometimes, and it's easier just to repeat stuff, Michelle, that you always do in there, to thinking like, which ones do I leave out? When should it go in? When you meet a threshold? Going through that evaluation, and you just sort of put it in there. But there's I think about pension accounting in particular. Pensions can cause problems for a lot of companies when you're underwater pensions, and it has in the past. But you see less pension being less important for a lot of companies, and it's really extensive disclosures that you have in financial statements around pensions, even on a quarterly basis. Think about the asset disclosures that you need to put in, and those don't always change necessarily, but they are required. Our pension footnote, between that and equity takes up about 30% of our disclosures in our financial statements, the two topics. So, but anyway.
It's helpful. Appreciate that. Randy?
Yeah, somebody asked the question about outdated disclosures. And as I listened to what is being proposed, like tariffs, it seems like that might be relevant for a relatively short period of time. The outdated disclosure that comes to mind right off the top of my head is the requirement to disclose the residential real estate loans in the process of foreclosure. Very important in 2009. I'm not sure beyond about 2012 that was a real relevant disclosure. So I don't know that this has ever been done, but would there be an opportunity if there were disclosures that were deemed to be necessary that may not have long-term implications, just write sunset provisions into the standards so they automatically go away as opposed to living in perpetuity in the standards.
Thanks, Randy. Okay, any other observations or questions before we go to the final chapter?
Okay. The final chapter, Chapter 8, related to current research projects that were on the research agenda when we issued the ITC in January. And the questions here asked for some direction and paths forward for these topics. This included the statement of cash flows, which received mixed feedback from stakeholders. Although users generally thought that this should be a top priority, they provided diverse views on how the board should address the topic. Preparers noted that they struggle with applying the guidance, which can lead to diversity in practice. And in general, stakeholders provided a really wide range of solutions that the board could consider, from target improvements to broad solutions. For KPIs and intangibles, stakeholders provided mixed feedback on these topics as well. As you may recall, both of these projects issued ITCs in late 2024. And in September of this year, the teams discussed feedback with the board at a public meeting. And during those meetings, the board provided some suggestions on and observations for kind of continued research efforts and how to prioritize continued research efforts on those topics. And with that, bring it back to Alicia.
Great. Jude?
A year ago, I suggested that if the board takes this on, does this, that you would be an orange deer on opening day in hunting season, which is actually Saturday morning in New York State. I'm not sure that works, so let's try it differently. I've been married 26 years. Lovely wife, terrific lady. We have 3 kids together. It's awesome. She occasionally will ask me, honey, do I look good in this dress? Okay. Don't like the question. So I tread lightly. And preferably, I don't answer the question, because either I'm telling the truth or I'm lying, I don't know, but it's in the eye of the beholder. And KPIs are just that. They're like that dress. I don't know. Don't go there. Let the users do it. Let them do it the way they want to. Just stay away from it.
Thanks, Jude. Marcel?
Just on the KPIs, and I agree with Richard or Jude in what he's saying around that it's so diverse and people have different views on how they interpret that. But Marshall, when you were in our offices in June, we had an interesting conversation about certain concepts and terms that companies generally use out there. That's not really defined in GAAP, but it's generally accepted that it's clearly understood. And there might be certain terminology that the FASB might look into that can help, like free cash flow, or like a very standardized definition of free cash flow. EBITDA, just those kind of things that can help with some SEC disclosures where the SEC gets really squirmish around certain how companies project or show certain information to users. And, I don't have an extensive library of that or what that would look like, but it could be interesting to see that you standardize some concepts beyond just net income, EPS, and so on, that gets widely used within the financial sort of realm. The statement of cash flows is just a topic that I would just highlight, that the direct cash flow, and I know we talked about that, some countries do that, but it's just not something that is really practical and very difficult to implement. Should that be, but I'm sure that the research would show that, and different views around that as you go down that route. But the KPIs is just really fraught for very different interpretation amongst companies in what's important.
Thank you. Jared?
Feels like Jude and I get to have this disagreement every 6 months. As I've said before, it would just be helpful if there was definition for these things. And, FASB is important to investors. And if you could help us on this, I understand there's risks and there will be issues, but it would be a great help to your users.
Thanks, Jared. Bob?
Yeah, I agree. I wouldn't go too wide on KPIs, but there is a lot of diversity in practice on a handful. The ones you mentioned, whether it's EBITDA or KPIs, and whether you try to standardize it or force some disclosure around it, I think that would be helpful.
Jared?
I concur on a narrow scope. We don't need a lot. Just start with a few. It doesn't need to be a huge project. Just start with EBITDA and see how that goes.
Michelle?
So I guess from your all's perspective on sort of wanting more standardization, is it that you just don't feel like the preparer's defining them? There's diversity, because I think about what we do for non-GAAP disclosures. I think the SEC has been, it's one of their most commented areas. At various companies I've worked for, we've gotten comments about it being, the GAAP disclosure not being more prominent, not defining it. So I think we're probably, as a preparer, we define our adjusted EBITDA probably 30 times in our earnings materials. And so it's I'm curious to understand sort of what are you all sort of looking for with that?
Bob, did you want to take that one? And then I'll move to Sheila.
I think I get you on adjusted EBITDA, right? Because that's got a lot of different things in it. Just base EBITDA, there's a lot of disparity in how people actually do that. Like, what is an I, what is an T? Yeah, that part of it, yeah. And then DNA too. There's a lot of games people play there. It seems logical, but amortization of sales commissions, right? So people try to load that in there and stuff.
Thanks, Bob. Shubu?
Yeah, hi. I agree with that. I think, in terms of which KPIs to use, that is, of course, the prerogative of the company in question and how they'd like to portray their financials to investors. But in terms of what the KPIs are per se, I think there has to be a standardized definition so that people are comparing apples to apples. And I think we raised free cash flow, for example. I know companies that would include advanced payments for purchases of property and equipment in it, and some won't. So there is no standardization there, or how, of course, the capitalized software expenses as part of the PP&E and then add the capitalized software. So I think it would be very helpful if there was a standardized definition of free cash flow, standardized definition of EBITDA and adjusted EBITDA, and then let the investors decide what they want to look at based on what's presented by the presenters and the companies themselves.
Christine and then Randy?
So when I hear what you just said about EBITDA, it sounds to me like it's really not about requiring all companies to disclose EBITDA. It's about the board defining what is interest, what is taxes, what is depreciation, and what is amortization in the case of EBITDA, and then just requiring those numbers to be disclosed either on the face of the statements, because some of them are already presented on the face of the statements, or disclosed in the footnotes. And to your point about free cash flow, it's really about a standard definition of cash flow from operations and cash flow from financing. Investing, the two components that go into the main cash flow metric. So it's not really about KPIs, in my view. It's about potential improvements to the financial statements themselves.
Randy?
I was going to move away from KPIs, so if there's still more to go on that, I'll cede the floor. I'm not sure if this is the right place, but on the consolidation for business entities, much like the challenges in significant influence and equity method accounting, I think there are challenges in determining control for consolidation purposes as well. and you get some differences, whether the entity is a voting interest model or variable interest model, on what constitutes control, including things like majority in interest of vote versus the majority in number of votes, which is a strange issue. So I think if there was an opportunity to kind of coalesce around consolidation based on a control model that could be well defined, I think that might help converge things and create a little less confusion, particularly in the VIE model.
Thanks, Randy. Rocky?
So again, thank you. I was also not sure if this is the right topic to bring here, but I also wanted to touch on royalty monetization. Few members within sort of the pharma biotech group had reached out to me to share some perspectives on royalty monetization, given how pervasive these transactions have become, particularly in life sciences space. And I've been, involved in structuring, evaluating such transactions over the years, both as a preparer and also part of the broader financial strategy. I think it's one area where accounting seems to be a little bit out of step with economic reality. Over the past decade alone, 30 billion of these transactions have been executed. And for many biotechs, royalty deals will continue to be the lifeline, given sort of the capital intensive nature of the industry. So the accounting model that we use creates a lot of complexity, sort of forcing these transactions to be viewed as debt, which doesn't really, jive from a buyer's perspective or from the seller side, and also from institutional investor side. So just wanted to bring that up as well.
Thank you. And I appreciate that. And this is really the time that if there wasn't a chapter that we touched on and you want to raise something that you haven't had a chance to, please feel free to do that as well. So appreciate that. Rich?
Yeah, I probably could just ask Randy since I'm sitting next to him, but on consolidation, one of the challenges we have, I think it's fair to say that people look at the model and don't really like it, right? It's complicated. There's two models. People aren't sure which model they should be in. Where we run into a problem, though, is when we say, okay, which consolidation answer are you coming up with today that you think you shouldn't? And we don't hear a lot about that. We're not hearing, and maybe Randy, you have a few examples, so we could get those from you offline, but we're not getting examples of this. In this instance, an entity is or isn't consolidating something, and we think the opposite answer is true. And one of the challenges we have is a lot of pain and investment, a lot of, let's call it sunk costs, went into the consolidation model from a preparer perspective and from an investor perspective on understanding what's in those financial statements. Without having an outcome we want to change, we have some hurdles. We really do. Would say a new model would be better, particularly because what we generally hear is a new model would be better, but get me the exact same answer you got me today. And we don't do real well with that. So I would just emphasize, if you're seeing transactions where something isn't consolidated that you think should be, or vice versa, those would be really helpful to us as we try to figure out what to do with this thing on our research agenda.
Thanks, Rich. Any other comments or observations from members around the table? Even if you didn't get a direct response to the point that you raised, please know that we were listening. We appreciate the feedback on the topics throughout today. And as I mentioned early on, this is really the first bite at the apple. Certainly there's going to be some topics that we bring back. So two more. One more. Okay, one more slide. Back to the team.
We just wanted to conclude today kind of with next steps and what you'll see next. So in October, as Tiffany mentioned, the staff presented a summary of the feedback to the board. So the board will start, as you saw, equity method just this past week. We'll start looking at that feedback and analyzing it and what against its overall agenda decision criteria and overall agenda prioritization to see what topics. This will be through a series of meetings that the board will have through 2025 and 2026. And then once the board has completed analyzing that feedback, you can look to see an agenda consultation report will be issued. And this will summarize how the board took all the feedback into account and how it affected standard setting. And so with that, I'll turn it back to Alicia for any final thoughts.
Great, thank you. And I'd just like to thank Erica and Tiffany for walking us through it and providing the details that they did today, and all of you. So unless there's any further observations or questions, we'll close out this session for a short break. And I'd ask you to reconvene here at 11 o'clock. So 10-minute break, and we'll start right at 11 with the PCC update. Thank you. Those online can just put on mute, and turn your camera off. Thank you. Okay, let's go ahead and get started on our last topic before lunch. So for our next session, I know our morning was really focused on the FASB, the projects completed. Really, this section is intended to dive into some of the research areas that the PCC is undertaking. And as I mentioned, Jerry Shaver, the PCC chair, is joining us for this discussion. But I'm going to turn it over to Jennifer Weiss, who's the PCC coordinator, and Ashley Allen, as well as Caitlin, who support, they're part of the FASB staff, and they support Jerry's and the PCC's activities. And they're going to bring us up to date on some research activities. So Jennifer?
Great. Thank you, Alicia. Good morning, everyone. So during this topic, as Alicia mentioned, we're going to talk about the PCC. Specifically, we will talk about their agenda priority process, 2 of their current research projects, and then we have some questions for PMAC members on those 2 current research projects. So the PCC, they use a structured process to evaluate what they should be working on, and they consider a handful of factors as they are evaluating their agenda priorities. To name a few of those factors: whether the issue is pervasive to private companies, whether technically feasible solutions exist or could be developed, whether the issues are supported by the private company decision-making framework. That framework is used by the PCC and the board in determining whether and in what circumstances to provide accounting differences for private companies. Another factor they use is the relative priority to the PCC and private company stakeholders. So is this a near-term or a longer-term need? Now, since the PCC launched this agenda priority process, a couple projects have been started and completed. There are several areas that the PCC considered and determined that the evaluation factors were not present and therefore discontinued research. And there are 3 current research areas. The 2 completed projects include credit losses topic 606 receivables project, which resulted in the issuance of ASU 2025-05 in July of this year, and presentation and disclosure of retainage for construction contractors wrapped up through the publication of a FASB staff educational paper. Areas in which the PCC considered but discontinued research include short cycle manufacturing, weighted average disclosures, and interest method in determining the effective interest rate. Now, the 3 current research projects that they're working on are lease accounting simplifications, subjective acceleration clauses, and debt modifications and extinguishments. And we're going to talk about the first 2 that I mentioned today. Before we move into subjective acceleration clauses, do PMAC members, have any questions or comments? Okay. I will turn it over to Ashley to talk about subjective acceleration clauses.
All right, thanks, Jennifer. Your meeting materials included a memo on the PCC's research project on subjective acceleration clauses, or SACs as I'll refer to them. Before we dive into these discussion questions, I will provide some brief background. So like Jennifer mentioned, the PCC has been prioritizing research on the guidance on SACs and determining the classification of debt as a current or non-current liability. The research project is based on feedback that SACs are pervasive in private company debt agreements, that the guidance is complex to apply, and that diversity exists in practice, and that these clauses are rarely actually enforced by lenders. At its September meeting, the PCC provided preliminary observations on potential private company accounting differences and requested that the staff perform additional research and outreach. So for some background, a SAC, which is often called a material adverse change clause within agreements, is a provision in a debt agreement in which a creditor can accelerate the scheduled maturities of the obligation under conditions that are not objectively determinable. And under current GAAP, when a long-term debt arrangement includes a SAC, entities must assess the likelihood of the lender accelerating the due date, which is referred to as the probability assessment. The outcome of that probability assessment determines whether the debt is classified as a current or non-current liability, and also whether disclosure is needed.
At its September meeting, PCC members preliminarily supported removing that probability assessment, and instead a SAC would affect the classification of debt only when it is triggered. If triggered, the long-term debt would be classified as a current liability. The PCC had a robust discussion surrounding what would constitute a trigger. Additional research is still being conducted in this area, but the PCC has preliminarily discussed describing triggered as when a lender demands repayment. There are a few other areas of the guidance that intersect with the guidance on SACs, including the intent and ability to refinance guidance and the classification of revolving credit agreements guidance. So the intent and ability to refinance guidance precludes non-current classification of short-term debt that is intended to be refinanced on a long-term basis by entering into a finance agreement before the financial statements are issued, if that financing agreement includes a SAC. The PCC preliminarily supported amending this guidance so that it is also trigger-based. So that is, if a trigger of the SAC does not exist, the short-term debt could be classified as a non-current liability, assuming the other conditions in the guidance are met. And if a trigger does exist, the short-term debt would remain a current liability. Moving on to revolving credit agreements. Under the current guidance, borrowings under certain revolving credit agreements are considered long-term debt because the borrowings are due at the end of a specified period, such as 3 years, rather than when the notes roll over. If these agreements also include a SAC, the effect of that SAC on classification is based on that probability assessment guidance. And some revolving credit agreements also include a requirement to maintain a lockbox whereby cash collections from customers are automatically deposited into the lockbox and then automatically applied to reduce the outstanding debt. Borrowings that contain both a lockbox requirement and a SAC are considered current unless certain refinancing conditions are met based on an agreement other than that revolving credit agreement. And then finally, some agreements include springing lock boxes whereby cash remittances do not automatically reduce the debt outstanding until and unless a lender exercises a SAC. Borrowings outstanding under these agreements are considered long-term since the remittances don't automatically reduce the debt outstanding, and the effect of a SAC depends on the probability assessment guidance. The PCC also preliminarily supported amending this guidance so that it is trigger-based, consistent with the other amendments that they're considering. So with that introduction, we can move on to the discussion questions, beginning with questions 1 and 2. So question 1 asks about the prevalence of the following in debt arrangements of public companies. So SACs or material adverse change clauses, lenders actually accelerating payment based on these clauses, and lockbox or springing lockbox arrangements with a SAC. And then question 2 asks how common it is for public companies to enter into financing agreements after the balance sheet date, but before the financial statements are issued with the intent to refinance on a long-term basis. And if those are common, do those commonly include SACs? With that, I'll open it up for questions on 1 and 2 before moving on to 3 through 5.
Thanks, Ashley. Anyone want to start us off on observations about prevalence? Marcel?
Not prevalent from my experience. I don't know what other people would say that works for public companies or maybe people that audit them, but I haven't seen this before in our company, at least.
Thank you. Jeff?
I haven't thought about this in a minute because because it's not as prevalent. But when I used to spend a lot of time with private companies, I saw it a lot. And I thought the tension was there's a going concern. There could be going concern issues is the tension. Right. And because the users of the financial statements are typically, I mean, it's not public, right? So it's going to be your lenders and things like that. And so they know everything already because you told them. And then there's this tension because of the subjectivity in these MACs and SACs, you may actually have to put it current, which would mean maybe you weren't a going concern or you get a going concern opinion. And it seemed a little odd because the lenders know everything already and they don't plan on actually invoking and enforcing that. So it kind of created a little inconsistency or potentially issues if you're private going into a IPO situation, right? And then I think I at least remember one situation where the IPO was a cure or among many other cures, but because of this type of thing, it caused a lot of tension on the going concern and can even kill an IPO in certain circumstances.
Thank you, Jeffrey. That's helpful. Gregory?
Yeah, from a public company perspective, I've seen it very little, and I think the memo, the white paper, reflected the fact that typically a public company will have a higher quality of legal representation that addresses it and takes it off the table, so they're not in those agreements. But like Jeff said, at the PCC level or the small business end of that, it's just there. I know I have, when we're talking about a trigger, I'm thinking, well, what is the trigger? Is it that legal piece of paper coming in, or I'm thinking of clients maybe less than maybe 500 million in revenue or something, that have been in turnaround situations, and the owners there, and I'm sitting with the owner and the bankers at the other end of the phone screaming at the owner that I want, we need our money. Is that a trigger? But there's definitely no legal paper that comes in, and the consultation is, well, just put the phone down when they're done hollering, then pick it up, and they have all this stress. But I don't see it at the public company level at all.
Thanks, Greg, and I appreciate the practical explanation of the dynamics. That's helpful. Bob?
Okay, yeah, I would say never, but my personal experience is I haven't seen it in a public company context, and I think, yeah, they tend to be more sophisticated, and the lawyers probably and the underwriters strongly advise don't have somebody that has the gun to your head, as a public company. And then I would say even in the private company space, it may depend on size, right? Because this whole lockbox concept implies there's a commercial banker out there, right? Whereas a lot of the larger transactions, more in private equity, it's all going to be with like these private credit funds that are providing the money, and they don't have the institutional capability to do the lockboxes. So that does not to say there might not be a revolver out there that requires it, but most of your debt's not going to be covered by the lockbox and subjectivity.
Thanks, Bob. Ryan?
Yeah, I would say my experience is it's limited, but I would say that I've actually seen instances where, based on the size of the registrant, namely like very small registrants and those that have lower credit quality, do have subjective acceleration clauses and max included in theirs. Whereas the larger registrants, you would not necessarily. I haven't seen it for larger registrants, particularly those that are higher credit quality. And it also depends on the lender. If you're going into, private lending arrangements as a small public company, because there's not a depth of availability of the market of lenders like willing to lend to you, that will make a difference as well, even if you have like really good counsel.
Thanks, Ryan. Randy?
Yeah, I was going to go to question 2, which on the financing agreements, and I can't conclude there's none out there, but I've never seen a financing agreement that didn't include a material adverse change clause. So I've never seen anybody get to an answer where they could classify debt as long-term based on a financing agreement. Consequently, until the loan is made, it doesn't qualify. And then the second comment I was going to make was, as you think about the subjective acceleration clauses, economically, is there really any difference between a subjective acceleration clause and a loan that's written on demand, but if no demand has a term feature? And if go down the path of the subjective acceleration clause would only be recognized on it if it was triggered, would you go down the same path if there was a loan written on demand, but if no demand, it termed a term feature?
Thanks, Randy. I think given just the comments that I've heard about prevalence around the table, perhaps we could go into the next questions about any observations on the PCC's preliminary ideas, realizing that it may be relatively short.
So the first question asks whether you have any questions or comments on the PCC's preliminary observations or solutions on the areas that we discussed. The second question, which we've touched on a bit, is what you think about the definition of triggered. And then the fifth question is whether you think there's any merit to extending any changes to other entities such as public companies.
Marcel?
When I read through the paper, I thought it made a lot of sense. All the recommendations, interpretations there seems very practical. I mean, some of the things that was highlighted there, that these triggers aren't, sort of like these companies or lenders don't normally call for these debt to be repaid. The courts would not normally sort of like allow those things to happen. So it sort of makes it sort of improbable just by definition. And the fact that nobody has called it and they would rather negotiate or find another way to get payment makes it almost impractical and irrelevant, even though they exist in practice in the documents and they can call on them. I like the way that the trigger is defined, and it seems very simplistic and very easy to sort of to interpret and what it means, and how you would apply that. And I would go further that even though it's not prevalent in public company debt, that it does make a lot of sense to apply it across the board to all guidance and all accounting, regardless of just private companies.
Thank you, Marcel. Any comments or observations from other members?
Concur with Marcel.
Thanks, Jeffrey. Okay, so let's go ahead and move to the next research project.
Great, thank you. Okay, so we're now going to talk about leases. The PCC continues to receive feedback that the leases guidance is costly and complex for private companies. But based on feedback received over the past 12 to 18 months, the PCC and its leases working group are researching the following areas, and these are all from a lessee perspective: an optional single lease classification accounting model, a low value lease exemption, embedded leases, and lease modifications. We will place most focus on the first two areas today, although we do have a question about the other two areas. Please note that this research is in its very early stages. You can move to the next slide. So we're first going to start with the optional single lease classification accounting model. As you're aware, the lessee accounting model distinguishes between two types of leases, either an operating or a finance lease. Well, for comparison, under International Financial Reporting Standards, or IFRS 16, lessees account for all leases in the same manner as finance leases. So the PCC is exploring an optional single lease accounting model for private company lessees. And in that model, all leases would be accounted for as finance leases. Feedback has suggested that an optional single lease accounting model could reduce the cost and complexity in applying the leases guidance for private companies. Next slide, please. So with the PCC's interest in exploring an option for private company lessees to account for all leases as finance leases, and in thinking about the potential benefits and cost, for example, significant changes to ratios such as EBITDA, and reducing cost and complexity of the guidance, what are PMAC members? Do you have any questions or comments on the PCC's research on potentially allowing an option for private company lessees to account for all leases as finance leases? So with that, I'll pause there for feedback.
Marcel?
I just want to comment, leases is something that's dear to my heart. It takes a lot of time in our company to get through every quarter. Any experiences that the FASB has seen with international accounting guidance and that the single model actually simplified and make it easier to account for? I know at the time when the dual model was introduced in the US and decided on, there was a very strong feeling that we need to continue the disclosure around, real estate leases predominantly in the way it is today, because it gives a better economic or indication of how it gets used and what it means and so on. But I don't necessarily think that having a single model would necessarily simplify cost, based on my experience dealing with both finance and real estate leases. And we still need to go through the consideration evaluation of, is it a lease or not a lease? How do you account for it? And all those kind of things. You still put it in a system. And I don't know, from a private company standpoint, how many leases people have. That's always difficult to judge. It's like how many leases people need to deal with, the complexity. But the time you're going to spend doing the one or the other is probably going to get 2 years to a very similar time, sort of like investment in getting to the accounting model that you apply. And then after that, stuff are mostly in autopilot for the most part, unless you get some modifications that occur. But you need to, in any case, apply across the models. So you put it in one system or the other system, now you account for it. And I suppose a lot of private companies and smaller companies do it in Excel spreadsheets and those kind of things, and not necessarily systems, although some of them could have huge lease portfolios. I just don't see necessarily a cost benefit. And I don't know how you evaluate that. And that's just on our experience dealing with a lot of leases on both categories across the board.
Thanks, Marcel. Jeff, Christine, and then Michelle.
I'm also curious about the European to international standards experience with that. I don't actually know. I just want to acknowledge the irony, right? Because I didn't, I thought we got here because we fought so hard to have the two models. So I just think it's ironic that we're kind of circling back. That's just my maybe not value added comment, but I think it's kind of funny that we're kind of coming full circle on it. So I have no objections with the current way we do it.
Thanks, Jeff. Christine?
I also find the irony of this humorous, but so I think that the two places where I've heard that it could reduce cost is in that just having to go through the initial classification decision and then with modifications. So there's been, a lot of feedback that we've gotten that modifications are just difficult and that they're more difficult when you have two models and you could end up with a reclass from operating to financing. From an investor perspective, I have heard some say that having the two models does create some lack of comparability because particularly on the cash flow statement, the classification of the lease payments between financing, which is outside of free cash flow, and operating, which is inside of free cash flow, can vary depending on just, very maybe economically similar leases, but, the dividing line can be very explicit.
Thanks, Christine. Michelle?
Maybe an edge case. One other thing to think about is, if you're in just a single model and you want to go public, or the comparability there, that feels like it could be an issue.
Thanks, Michelle. Sue?
So maybe just to comment on your two questions about international. So they just started their PIR on their leasing standards, so we don't have good data on it. But I think that at the time when the standard was being developed, they clearly got different feedback, both from their investors and from their preparers, well, mostly from their investors, on this notion of a dual model. So I think that, our starting points were a little bit different. And I do wonder what the perception would be about everything considered to be a finance lease. But I do think that, not to get a segue into the next topic, I do think that maybe there's more opportunity for the low value, just in terms of, I think some of the sentiment that we've, heard over time is around just the recognition on balance sheet at the private company level.
And just to add, a lot of leases don't go to that evaluation of the 70, do you read that threshold? Most of them are plain vanilla, down the middle, you count for them. It's very infrequent that you have to sort of look at those really tough decisions on how something fits.
Sue?
And the other thing I might mention is in the smaller company space, the IFRS standards don't apply. Their new leasing standard doesn't apply to their private company community. So that's a difference as well.
Thanks, Sue. So I've got Rich and then Dude and then Christine.
Sure. I'll probably join the irony group. When this model was being developed, the interesting thing was the main criticism about finance leases for all was it was going to front load the expense. Particularly think about like real estate leases. So you have a 20-year real estate lease, maybe it's an operating lease, or a 10-year, let's make it 10-year. Because it accelerates all the expense, you actually end up with a lease that doesn't mirror what they view as the economics, which is really that the costs would rise over time. So you'd have this front-loaded expense there. And what I recall was that lessees particularly didn't view they were buying the asset, and then they then when they were faced with this front loading expense, they didn't care for it. And that was similar to the feedback that I thought we heard from investors at the time. So it would be interesting if investors had a different view of that type of transaction today than they did back when the board created the two models.
Thanks, Rich. Dude?
Rich, you're headed toward the dark side. I can see it. If I were the god of accounting, I would look at this and say, okay, just in small companies and private companies, just to get the right to use asset on the balance sheet and obviously the corresponding liability, that's the win. That's where it's at. That's the win. I absolutely think finance leases, that's where the brain damage is. Blah, 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 creating all that. And I don't like the front load. And it's just, if I were the god of accounting, it'd be straight line, boom. That would be the end of it.
Thanks, Dude. Christine?
Always hard to follow, Dude. So I think that going back to your comments about cost, it's really, I think, important for the PCC to understand really what that cost savings would be, because this would not be a practical expedient. It would be an exception for recognition and measurement. And there's a pretty high bar for an exception. And the private company decision-making framework actually requires that we consider both the impact on the relevance of the information to investors and also the cost savings, but that when it comes to differences in recognition and measurement, that we actually put more emphasis on the impact on the relevance of the information to investors, which says to me that there's got to be a pretty significant amount of cost savings that we can, count on from doing anything like this, because I think it's pretty clear that optionality never improves the relevance of information for investors. So we know that there's going to be some pain there for investors.
Thanks, Christine. Any other comments on this topic before we move to, go ahead, Greg.
I was just gonna say, I'm surprised the private companies didn't just say, let us go back to expensing it. There you go. Okay, got it. That's, and we'll disclose the commitments. Like,
I think if we look at complexity, if we look at a point in time and we're assessing the lease today for the financial statement disclosure or reporting, but if we look over time with leases, I think they have evolved and they may start out as a simple lease or a vanilla lease, but the industry every year makes it more complex. And if we look at it, maybe on the financing side, like a loan, it's, a lease modification is just like refinancing, and yes, it's going to be complex to really dive into it. And, it's complex to look and see if a contract if a lease is embedded in a contract or something like that. But it just, all those things just over time, over the last 20 years, it just keeps on cutting, every day there's a new lease that attribute that comes out that makes it complex. And I don't know that we'll ever get away from the complexity.
Thanks, Greg. I have Shubu and then Stephen.
I just, I think the little bit of devil in the details here, especially, I keep going back to these new companies that are coming out with AI, HPC and Bitcoin use cases, etc. So, companies, what they're now calling the neo clouds, they have a mix of both operating and finance leases, depending on the kind of customers they can rent on the back end. Right. So, for example, a hyperscaler like Microsoft or Nebius or Core Scientific, when they're looking for long-term infrastructure bills, which runs into tens of billions of dollars, they're looking for a finance lease. They're looking for 10 to 15 year sort of take or pay lease agreements. Whereas there are other times where Lambda Labs or CoreWeave or these kind of companies, they're looking for a quick fix, get a quick customer, typically 2 to 5 year GPU rentals that they can't afford to buy outright. So they're renting these GPUs, NVIDIA GPUs, and turning it around and giving out, leasing out in 2 to 5 year operating leases. So I think the prerogative again should fall on the kind of business plan, the business model that's evolving now, especially with, for example, Stargate is a $40 billion project. So I think there is a lot of detail here and a lot of customer preference based on the length of contracts that should also be taken into account, and therefore kind of stipulating that most leases should be financed versus operating. I think should fall on the obviously the people who are leasing.
Thank you. And Stephen?
Yeah, in similar veins, I think, I've dealt with leases that are, now recently do a lot of the government taxing, local government taxing is related to the lease amount. And then I also deal with a lot of free rent kind of applications. So trying to determine how to properly account for those. Just wanted to highlight those.
Thank you. Appreciate that, Stephen. Any other observations on this area? Questions? Okay, if not, let's go into low value leases.
Okay, and the next area the PCC is exploring is low value leases. GAAP does not include a recognition and measurement exemption for leases of low value assets. At the time the leases guidance was being developed, the FASB board members considered such an exemption, but concluded that it was not necessary because entities could adopt reasonable capitalization thresholds, similar to capitalization thresholds that entities have developed to capitalize property and equipment. Now, under IFRS 16, a lessee is permitted a recognition and measurement exemption for leases of underlying assets that are low value. And if you look at the basis for conclusions of IFRS 16, it explains that these are assets of approximately $5,000 or less. So when a lessee elects this exemption, they are required to disclose the expense associated with the low value lease. You can move to the next slide. So at a FASB leases roundtable in September, some stakeholders indicated that a low value lease exemption could reduce some of the costs in applying the leases guidance. So the PCC decided that this would be an area that they should explore for private company simplification. So with that brief overview, let's move to the discussion questions on the next slide. The first question is for the investors or users on PMAC. If a low value lease exemption option was made available, how would that affect your financial statement analysis and capital allocation decisions? And what information, if any, would you need to perform your financial statement analysis? I'll pause there for input.
Dude?
Before we get all excited about thinking about this, it's already happening. All day long, it's happening everywhere across the economy. Everybody's, a copier? No chance. That is not, no. That people don't even think about them. So my point is, like, low value leases, this is already like unofficial GAAP, is my take.
We'll open it up to preparers, practitioners, and investors, given the enthusiasm around the room. Marcel?
I just want to add to what Dude says, and that's exactly, if you write it into GAAP with an exception, or you practically apply materiality, you get to exactly the same answer. The one just captures it in language, but for us as a company, and I borrowed this from another very large public company, well-known company, they talked about their leases at the time of the implementation and how they're going to scope certain leases out of applying this, more practically the copiers, the small kind of things. And they made the suggestion, or when we had the discussion, they determined that those things are immaterial to their financial statements as a whole. And what they've been doing, and we've sort of implemented that at the time, which actually works really well, is they evaluate all their copier leases, make a list, make a determination they really, immaterial, look at your annual expense and how long these things are in sort of like on one time a year. You book a liability, you book an asset, you use some discount rate, you apply to that, and you have it in your books. And when you actually expense it, you book it straight to the P&L. And then every year you just evaluate. Did it change materially? And you keep it in your book. So people, we're doing that. Other people are doing the same. It keeps with the spirit of the disclosures. You still have your liability and your assets in your books. You still show the expense that you incur. But it's not material. It doesn't move the needle. But it saved us a ton of time, because if we had to apply the model to all those things, it would have taken probably the same amount of time than for all our other leases, real estate leases. And leases for us at the time when we put in the standard was almost 10% of our total balance sheet. So it was fairly significant for us in total, but saved a ton of time doing that. Very easy to apply. And to its point, people are doing it today. So,
Thanks, Marcel. Appreciate that. Michelle?
Yeah, I mean, I think along those lines, I'm curious what the hesitation is for just a capitalization threshold, right? I mean, it's basically what people are doing now. Yeah, even, you make a list, to Marcel's point. Yeah, I think just writing into the guidance overcomplicates it. Just use a capitalization threshold or make a list, and folks are doing that, I think, already.
the only question or problem with that is you put a threshold, it's different for every company. $5,000
But
is
you
not
use
the same for
material-
every
but, like,
company.
Assess materiality, to your point, to say, do a materiality assessment and say, this number is just not material for us.
It could be 5,000 for some, it could be hundreds of
Yes.
thousands for
Exactly.
others.
100 yeah,
basically,
100%.
Yeah, and GAAP already have the concept of materiality. And
Exactly.
GAAP only applies to material concepts and issues that you need to account for. So, that's just, it's nice having it, but I don't think what's different.
Yeah, I agree. I mean, that's what we do. We apply a materiality threshold to everything we do.
I agree with the group that it's universally applied. Nearly universally applied.
Penny, did you want to get in as well?
I mean, I just agree with all the commentary so far. I think it's prevalent, especially in private companies, private equity-backed companies. They're using materiality, so I don't think there's a real cost savings in doing anything different to the guidance.
Thanks, Penny. Randy and then Greg?
Yeah, I would agree with that. But the only thing I would add is I do think there ought to be some consistency in what is defined between property and equipment and the lease standard. So if something is done here, it ought to be consistent with what is reflected in recognition for property and equipment.
Thanks, Randy. Greg and then Ryan?
If a company enters into a low value lease or has that population of low value leases, and they don't, and they decide not to incur the cost to see or test the type of lease, and they just say everything is low value, and it's determined that it's immaterial, which is what we're talking about, that still may be okay, but are they running into an issue, the small business or the PCC within those businesses, those private businesses, are they running into an issue with outside of the FASB, but the AICPA with the auditor or accepting a qualified opinion because of leases and just saying they're immaterial and we haven't addressed it? Or are they still, as a small business, trying to get that unqualified opinion, and it's going to cost them a lot of money to get there, to go through and test leases to see if they do have a finance lease versus just saying they're all low value leases? And so maybe there's something already in the mechanism by coming through the AICPA and the audit and that piece. And then does it get to the business to properly communicate that with their users at the private level?
Thanks, Greg. Ryan?
Yeah, I'm a full supporter of capitalization thresholds and materiality assessments, just for practicality. But I would say that the consequence of capitalization thresholds can be sometimes that there's still more work to be done as a result of the capitalization thresholds. I've been in a large manufacturing organization once that annually with the auditor, we would have to go through an analysis of the capitalization thresholds to demonstrate that it didn't have a material impact of any sort from the financials. So it still took work. So there is still work related to that. And that was because they viewed it as a non-GAAP type item, since it's not explicitly in GAAP. So I would say that in thinking about it, while I support it, there are some like downstream consequences from just a regulatory and audit perspective.
Thanks, Ryan. That's helpful. Jude, did you have your tag up from before, or is that okay? Oh, that's okay. Any other observations or comments? I know we've had some conversations about materiality, but from an investor perspective, any other observations about this area that you want to bring in? Okay. Do you want to move to lease exemption, or sorry,
Yep,
embedded
leases and lease
mods?
modifications, yeah. So during the FASB's September Leases Roundtable and through outreach conducted by the PCC Leases Working Group, some have indicated that identifying embedded leases continues to be challenging. PCC members preliminarily discussed some sort of simplification that would provide private company lessees with a screen or a threshold to determine whether a lessee needs to evaluate a contract for embedded leases. And then on lease modifications, some indicated that applying the lease modifications guidance is challenging to apply. And so this is an area that we'll need more information about what specific aspects are difficult to apply before the PCC can make progress. And so we've got a couple of questions for you on the next slide. So are there ongoing costs and complexities in identifying embedded leases? And are there ongoing costs and complexities in applying the lease modifications guidance?
Marcel?
We don't have a lot of embedded leases really, but we have quite a significant amount of modifications. And I mean, it's similar to implementing lease standard. I know you just went recently through the whole evaluation of the project. It costs more money, but it definitely created a much higher quality disclosure and presentation information from my perspective. But it's a cost. It's something that needs to be evaluated on an ongoing basis. And I don't know how you change it to simplify it. I mean, people change. Having a lease by itself is a really expensive thing, as most people would know. It's also a very unfavorable thing because it doesn't give you a lot of flexibility. Modifications is one of those things that you, from a financial and economic standpoint, can benefit you as a company economically. And, you know, it's just part of the cost of reflecting that. But it does take time and effort to go through that, almost like a new lease that you account for in any period of time. And how do you determine the difference and how do you affect it?
Thanks, Marcel. Greg?
Again, I think on embedded leases, I'm thinking back to the practicality of sitting there and who in the finance function do I ask to assess if that contract has an embedded lease? And typically I'm pushing it ends up being pushed down to a 2, 3, 5-year experienced person who doesn't have the knowledge. And therefore it becomes very complex to assess if it's embedded or not. But you're asking them, you know, a couple of years ago, look at every contract to see if there is, you know, any contract that you see that the company enters into, go to legal, gather those, and we have to see if any of those have embedded leases in them. But, yeah, so I don't know if it's a lack of knowledge on the resources that causes that, but or how to assess it, but typically it's pushed way down in terms of doing the initial assessment. And you know, I think it's just a practical thing.
Thanks, Craig. Jeff? Oh, sorry, Marcel, did you want to respond?
Response to that, I think that's a good question that you say. It's like, and I think that's a lot of the problems that private companies deal with a lot of times, and even public companies, is the level of experience of the people that you have within the rank and file of your accounting shop. And I would always like want to infer, and I might be totally wrong here, that often when you have embedded leases, it's more sophisticated entities. That's maybe larger. Even on the private side, it's people that can afford, they can go into transactions that contain embedded leases and evaluate those. Then they probably can afford to pay for the accounting expertise to evaluate them, account for it, which is like a really silly way of thinking about that. But it's par for the course kind of thing. But agree with you that should that ever happen, that an embedded lease comes down, that's often the case, that it's difficult to evaluate. But GAAP is fraught with that throughout all disclosures. It's not only isolated to this particular aspect of accounting. But I do want to say, my feeling is that embedded leases goes with the sophistication of companies that can afford dealing with this much better than other companies.
Yeah, and the examples that come to my mind are I'm going through the public companies that I've worked on, and you know, just So you got lots and lots of people there within finance and accounting, but still, who are you assigning down into the lease accounting area?
I kind of was wondering if the embedded leases was more of an issue on the lessor side or the lessee side. Do we have any feedback on that? Because I think I've seen it more pop up as a problem on the lessor side when you don't realize that you might have an embedded lease when you're in a revenue contract. Like maybe that's because I feel like on the lessee side, you kind of know you have a lease. So I'm just kind of curious the genesis of that embedded. Because I don't know, it's kind of like you could have embedded derivatives, you could have embedded leases, but I think from a private company perspective, I could see this being challenging just because of resourcing and skill set, which I think the two of you brought up, because the model is more complex. For example, on a modification, you could have impairments, you could have other things happening in that maybe a private company isn't well suited to think through and handle. I think perhaps you could mess it up more easily as a private company versus maybe as a public company when you're kind of really focused on getting that right. Because of the inherent complexities we introduce when we introduce the models into the lease accounting, I think it's easier to get it wrong for private companies. Maybe that's what they're trying to figure out. But I'm curious about the embedded lease problem, if that's a lessor or a lessee. My hypothesis it's lessor, but I'm kind of curious like where that's coming from.
Yeah, and Jennifer, correct me if I'm wrong, but because of how this issue is coming up, and we did have a leases roundtable, but we're primarily hearing this feedback from a lessee perspective in terms of the embedded leases. So appreciate those comments, but I think it's really from the perspective of the companies trying to identify aspects within the leases or leased assets that they have. So we've got Jude and then Marcel and then Rocky.
Go ahead, be jealous. My industry has way better toys than yours. Road construction, bridge construction, way cool toys. And we were scared to death of the concept of embedded leases as an industry. The highway business in the United States is mostly private companies, almost exclusively. There's some big ones, but it's mostly small. And we were all scared to death. But as we thought about it, we got to the place where, wait a minute, that subcontract is really just a service. That huge crane that's worth $20 million that we're going to have for 2 years, that's just steel erection. And the subcontractor, we have an agreement with them. And so we've gotten a lot less afraid of it, of the issue of embedded leases. Like, it's service. That's the way we wash it. But I'm not sure it's right, but that's what we do.
Marcel?
And Jeff brought us something, and that's sort of surprising when I was going through materials. From my experience, I would think that private companies would struggle a lot more with lease impairments, with some of the classification amongst abandonments and impairments, and where does it go in the P&L, which seems to us in our portfolio that we deal with to be much more judgmental and difficult to apply than a modification. And our embedded lease is a different thing. But so you brought that up, and I thought about that when I was reading the materials.
Rocky?
So I think just adding on to the contract parsing burden, I think in reality, embedded lease identification does require a lot of manual review of hundreds of contracts, especially like if they keep going through modifications. And I think just one other point to consider is it gets especially complicated for service or outsourcing agreements where sometimes the control and assets specifically aren't clear cut out. I think that's where it gets like really complicated.
Thanks, Rocky. And I would just point out, we recently had some conversations as part of the closeout session on our post-implementation for leases, but I would observe that the board is always open to hearing additional inputs as transactions evolve. Jeff, I know you mentioned from a lessor perspective, identification of a contract requires both parties to the contract to identify it. So if there are additional issues that arise, we're certainly open to hearing those as well. So any other observations on embedded leases or modifications from a lessee perspective? Or any additional questions from Jennifer, from Jerry, or from Sue in terms of your involvement with the PCC working group that would be helpful to ask this group before we close out?
I'll just say thank you guys for your feedback and input. One of the the great opportunities in being able to talk to people where you guys are close to the line is as we ponder these issues, much of the time we try to say, if you want to be public, you should not be paying attention to what we're doing. That you should be focused on what the public side is, because ultimately it's going to cost you more. But you're a crossover group, and so your input's very valuable. So thank you for letting me sit in and your contributions to our thought process.
Great. Appreciate your participation, Jerry. So with that, we're going to take a break for lunch. So we've got lunch between noon and 1 p.m. I would just like to mention a few of you have expressed an interest in touring our office facilities, which we're really happy to accommodate. So if you'd like to do that, Alden and Denise will facilitate that. So if you could just, around 12:35 or so, and if you're interested in that, in our lunchroom, they'll take you on a tour. Thank you. And we'll extend that to those that are virtual next meeting, we promise. And for those that are virtual, if you just want to turn your cameras off, make sure your computer's on mute, and we will reconvene at 1 p.m. Thank you. Okay, let's go ahead and get started again. Just welcome back. Hope everyone enjoyed the lunch and those of you that took the tour. So for this afternoon, we have 2 technical topics on financial instrument related areas, and then a discussion about technology. So the first of those is on the accounting for derivatives. So for this topic, Ken Matsui is going to introduce the topic, and then we're also joined by Alex Cassis, who's the assistant director on our next 2 topics. So he'll be at the table for both. So Ken?
Thank you. So today we are here to discuss the accounting for derivatives project that is currently on our research agenda. Through our last 2 agenda consultations, stakeholders commented on a variety of aspects of derivative accounting, including the definition of derivative scope exceptions, the bifurcation criteria for embedded derivative, and accounting for derivative contract modifications. Flip the page, please. Stakeholders provided a variety of feedback on the definition of derivative and scope exceptions. Guidance on derivative accounting was originally issued in 1998, and the board provided a definition of derivative instruments based on 3 distinguishing characteristics. That is, a contract must have underlying with a notional amount or payment provisions, no or minimal initial net investment, and the net settlement provisions. The board also provided a list of scope exceptions for certain types of contract. Stakeholders noted the broad interpretations of the derivative definition, and because of that, certain contracts are swept into derivative accounting, which stakeholders believe may not provide decision-useful information to investors. To address some of this feedback, earlier this year, the board issued a guidance that added the new scope exceptions for certain arrangements such as R&D funding arrangements and litigation funding arrangements. The other feedback on the definition of derivative and scope exception includes diversity in the application of the initial net investment criterion and the difficulties applying the normal purchase and normal sales derivative scope exception to certain long-term contracts. Many stakeholders also commented on derivative modifications. Those stakeholders noted that there is a lack of guidance for derivative modifications, and in practice, any change in amount and timing of cash flows is considered the termination of existing derivative and the issuance of a new contract, resulting in most modifications as the extinguishment of old contract and the creation of a new contract. The new contract will have a build-up fair value when the contract is modified, and that build-up fair value is considered an initial net investment for the purpose of a derivative definition evaluation, often causing the new contract to fail to meet the derivative definition. In that case, if the new contract fails to meet the derivative definition, it would be considered a hybrid financial instruments that must be bifurcated into a host contract and the embedded derivative if it meets the bifurcation criteria. Also, there are some implications to how cash flows would be reported in the statement cash flow and difficulty redesignating hedge accounting. Stakeholders noted that those accounting outcomes do not provide investors with decision-useful information. Lastly, stakeholders noted that there has been an increase in private companies entering into complex financing instruments, and embedded derivative guidance is costly and time-consuming and often involves significant judgment in general. Those stakeholders noted that difficulties often arise in identifying embedded derivatives and determining whether they are clearly and closely related to the host contract. Furthermore, some stakeholders noted that certain contracts that require bifurcation may not provide investors with decision-useful information. So questions. To help us with our ongoing research in this area, we have a few questions for PMAC members. Whether there are any arrangements that are currently accounted for the derivative but fair value accounting does not provide decision-useful information, whether there are any challenges in applying a derivative accounting guidance, and which derivative accounting issues should be addressed by the board. Now I'll turn it over for discussion.
Thanks, Ken. Appreciate that introduction. And I know this is a tough topic to jump into right after lunch, but I think really the purpose of it is to get some early input from you all around the table to help understand some of the areas that you're facing. I know we don't have a significant representation from financial institutions, but I think that this is an area that's important to all companies. So just really interested in hearing any feedback that you might have. Does anyone want to start us off on the derivatives topic? Greg?
When derivatives come to mind within the business and reporting and what to do, the first thing comes to mind, maybe just to start off, is just to try to understand the economics of the transaction. And you know, if you've already identified or is something there, but you know, what is really happening? Why did management decide to enter into this, and what is it? And maybe that gives you that guidance to where you start looking at it. But that seems to be, you know, a starting point in terms of analyzing before you even get into the accounting of. And maybe similar to when we're talking about embedded derivatives, maybe that's the same question as embedded leases, and trying to figure out, do you have a lease or do you have a derivative here or not? And a lot of times it's a very difficult discussion that you have. And I'm thinking on the, say if you're a manufacturer and you're buying supply, and you may have a supply agreement that goes on for 5-10 years, and there's derivatives throughout that based on different milestones that you have to pick out. But it's just understanding what the economics was first.
Thanks, Greg. And thinking about understanding the economics and then applying the existing guidance that Ken went through, I'd be curious if there's any people around the table that have observations about areas of the guidance that seem to work well, areas of the guidance that seem to present challenges for either you or for your clients. And then from an investment perspective, I know we've had some discussion this morning on the derivatives disclosures that are provided, but any observations that you have from that perspective also would be helpful. Randy?
Yeah, in general, the accounting for derivatives to me is not that difficult. I mean, it's hedge accounting that becomes more problematic from the accounting standpoint. If there's a challenge in the derivatives, it's the embedded derivatives. We talked about embedded leases and how complicated it is. The number of contracts that could contain an embedded derivative, when you look at the strict definition of the criteria for a derivative, there are a lot of contracts that could contain an embedded derivative. So to me, that's the real challenge in applying it, is identifying you have the instrument itself and then figuring out whether you have to bifurcate it or not.
I guess just to follow on to that, are there contracts or groups of contracts that we ought to be looking at where there are decisions that are on the edge to better understand, to make sure that we have the definitional described in the right way? Any of those would be helpful to hear, or if we have it about the right place, that's fine too. But
Rich?
Yeah, so I'm not surprised it's a little quiet. I think this is a hard topic without examples to really discuss, to bring home. So I think one of the examples in the slide is the normal purchase and normal sale exception for long-term power arrangements. And I think that's a good one to illustrate, is there value conveyed by derivative accounting in that or not? So take, for example, I'm building a data center. I need power. I'm going to enter into long-term fixed price or a long-term fixed price power commitment. And that's the only way someone's going to build a power plant. But I may not be able to use all the power. I may not, and I can't store it and say I'll use it later. Forget about batteries. I really can't store it. If I can't say that I'm going to use a certain amount of that power, I don't meet the normal purchase and normal sale exception. So now I have this 20 years power supply arrangement that I have to fair value. Now to fair value it, if anybody knows how long the forward curve on electricity goes out more than I do, but let's guess it goes out a couple of years. So now I'm going out 2 years with that forward curve, and then I'm going to guess at the price of power, and I can hire a really smart person who's going to give me a great model from years 3 through 20. And I'm going to fair value that on a constant basis. Is that informative to the user? Is that the best way of measuring, of reflecting that contract? So that might be an example that we could, you might be able to give some input on, or you may have some experience with. But I think examples like that, and if it was normal purchase, normal sale, I'd do no accounting for it, right? I'd effectively just account for the power as I bought it. But because I don't meet certain criteria, I'm going to fair value it. Is that the most relevant measure?
Thanks, Rich. Got Greg and then Hillary.
To piggyback what Rich just said in the example, what came to mind was, and maybe I can kind of relate to it, is the Southwest Airlines fuel derivative, which put them at an advantage against their competition for years and years and years until that contract ran out. And I don't know where to go with it, but at least I'm identifying, that may be, an example to try to think about, or the electric supply that he's talking about.
Hillary?
And I think maybe just parlaying off of what Rich was talking about from an example perspective, I think when the derivative guidance was put in place, right, we have a pretty broad definition of a derivative. And I think over time, that has been even interpreted even more broadly than the board necessarily expected it to be. And so we have a lot of scope exceptions, right? Because we have this broad definition of a derivative, we tend to have a lot of different scope exceptions that exist. Now, some of those were put in place when the derivative guidance was originally put in place, but it was probably some of those scope exceptions, like normal purchase, normal sale, were put in place that were much more, I would say, precise. They required a lot of, precision in applying it. And I think that's something that maybe over time, as we think about it, may not be necessary, right? May be resulting in not providing certain, decision useful information to investors. So I think part of what we're thinking about with some of the feedback that we've gotten, we obviously just completed our derivative scope refinement project, which provided another scope exception, right? For instances where you have certain underlyings that are based on the entity's own operations, which I think results in a good outcome of less things being derivatives. But I think kind of to Rich's point, right, maybe some of the existing scope exceptions that were there to really help entities maybe haven't aged quite as well as maybe they could, or maybe they're
they need to be relooked at with regards to the type of contracts that are out there today. So those are all things I think we're open to, and I think that's just an example of that. But it's probably a broader question. I know we talked about it with the existing, liability and equity, the liability scope exception, right? So it's kind of a theme that I think we're seeing across the derivative space. So open if there's any feedback that you might have today or any other time with regards to this topic.
Thanks, Hillary. Jeff?
Yeah, I guess I'll just provide some general feedback. I don't have a specific example because I guess with my hat on as a preparer, I feel like this space, especially the embedded derivatives, is kind of like one of the spaces that is ripe for like overreaction and underreaction, right? Because they're embedded, right? So you can miss them. And so I think one of the phenomenon that happens is like this is a space that's become very, very specialized, right? So we have people that do nothing but derivatives, right? They go, it's like a little cottage, it's more than a small cottage industry of just doing derivatives, right? And so every time they look at contracts, guess what? They see derivatives and a lot of them. And that might not be the same way that a general practitioner might view it, right? Like a general accountant versus like a specialized accountant in derivatives. And then, because of that, you can actually go the other way too, where like if you're just reading through contracts, you may underappreciate that maybe there is a potential embedded risk because you've hit the 3 criteria, but it's not clear. So it's kind of a ripe area where you can kind of get it wrong both ways. So I think maybe this is my perspective, just echoing what Hillary's saying, which is this is an area where maybe we could simplify and make things improved, because it seems like we have been solving for very discrete use cases, which makes sense, but maybe there's a way for us to simplify this overall model. Like, for example, like what I typically do is when I read a contract and I sense there's a disturbance in the force and there's a potential derivative, I usually call for specialized expertise, right, to make sure we get it right. So that's kind of how I generally react to it. And there's places that you expect them, right? If you're doing like a complicated financing instrument, then you would expect that there's possibility for that. So you'd be expecting it. I think where sometimes maybe they might be caught in where people think of as a normal service contract, or that's perhaps where it can get a little more tricky for practitioners.
Thanks, Jeff. Appreciate that. Jared?
Yeah, just going back to Rich's power supply example, the simple answer to your question is yes, but what are my other choices besides fair value?
It's as an executory contract, and you may have disclosure of terms, and you may have a termination value that you would understand what it is contractually, but it would be different. You'd account for the items as you purchase them.
Any other suggestions, comments, observations on this area? Uraj? Uraj, I think you're on mute.
Sorry about that. Yeah, I was just saying, like, this is maybe slightly off topic, but in general, with respect to the decision usefulness of fair value accounting, I have a paper where we dug into this, and what we notice is it's not just that fair value accounting is decision useful or not, but to understand how the changes in fair value are impacting the different parts of the financial statement. So while you can disclose the fair value and their changes in the footnotes, what seemed to have really helped investors in avoiding mispricing companies is to understand which line items on the balance sheet and the income statement were being impacted by these changes. So I think that might be a little outside the scope of what you're looking, but if you encounter some of those things where you're changing or thinking of changing disclosures, keeping that in mind might be helpful.
Thank you. Much appreciated. Any other comments, thoughts, questions on this area? Okay. Thanks, Ken. I appreciate it. And again, like Hillary mentioned, if you've got additional thoughts as this progresses, we're happy to entertain those as well. So with that, let's go ahead and go to our next topic, which is on the post-implementation review of CECL. And like leases, and I know we've had a lot of conversations about leases over the last couple of years, CECL is also in the process of its post-implementation review. So I'm going to turn it over to Dan for some comments, and then we'll get into some discussion questions.
Yep. Thank you, Alicia. Good afternoon, everyone. In connection with the ongoing post-implementation review of the CECL standard, we're asking the committee for feedback on the application of CECL and any costs or benefits. As a brief background, the CECL standard was issued in 2016. It became effective for public companies in 2020 and non-public companies in 2023. CECL is an expected loss model for measuring credit impairment. And a significant change from the incurred loss model that CECL superseded. An incurred loss was recognized as credit loss expense when the loss was probable and reasonably estimable. Following the 2007 global financial crisis, stakeholders criticized the incurred loss recognition threshold for excluding losses that could not yet be deemed probable, despite being expected by creditors and investors. The board considered several alternative impairment models that incorporate forward-looking information to better align the financial statements with the market's perception of credit risk. And the CECL model ultimately codified in topic 3 is ultimately codified in topic 326 with measurement guidance for financial assets carried at amortized cost. There is no threshold for recognition under CECL. The amortized cost basis net of an allowance on the balance sheet should always equal the amount an entity expects to collect. CECL requires an entity to measure expected credit losses on pools of assets with shared risk characteristics using information relating to past events, current conditions, and reasonable and supportable forecasts of the future as of each balance sheet date. The post-implementation review of CECL began when the standard was issued in update 2016-13. A transition resource group was formed to address implementation issues emerging in real time. The FASB staff published Q&A educational materials on implementing the WARM method, the weighted average remaining maturity method, to measuring a CECL allowance. And another Q&A on the application of historical loss information, application of forecasts to historical loss information. And the board also hosted public roundtables in 2019 and 2021. To date, the board has issued 4 ASUs to improve or clarify the CECL guidance as a result of PIR feedback. However, the process remains ongoing, and we continue to solicit feedback to evaluate the effectiveness of CECL. So with that, unless there are any questions on the materials that were distributed, I'll pass it back to Alicia to facilitate questions 1, 2, and 3.
Great. Any questions for Dan? Okay. So we've got just some broad questions about any observations that you're seeing given current application, current use of information, any insights that you have. And Dan briefly walked through the history in terms of when this was issued, but just open it up for conversation and start with Jude.
I've spent, 25 or 28 years as a bank director, starting with a very small bank in the range of, my grandfather bought a bank in 1931. We ended up selling it in 20. But when we sold it, it was $350 million in total assets. And my observation is that the smaller the bank, the less of a change it was to go to CECL. That might sound counterintuitive because all I had to do was the head lender at Bank of Akron to say, what do you think? And he did in his head. There it was. And now I'm on a bank board of a $3 billion bank. And it's not quite like that, but it's sort of close. And CECL for the bank that I'm on, Chemung Canal Trust Company, not that big a deal. I mean, yeah, there was a lot of screaming and bitching when it came out, but it didn't amount to a whole hell of a lot. So but I have no comment on big banks. My guess is for them, it's a world of difference.
Thanks, dude. Jared?
I'm not a financials expert by any stretch of the imagination, but talking to my analysts that do cover the banks, the general consensus is yes, CECL was a significant improvement. And then, the biggest issues are just the different models people are using, the lack of comparability. So, the pro-cyclical nature of it, after COVID, you had a lot of provision releasing. But with all that, it still seems to be significant improvement and they generally like it. But those are kind of their big issues that I'm getting from my financial analysts.
Thanks, Jared. And I appreciate you reaching out as well. Christine?
Yeah, I just wondered, and maybe you haven't asked them this question, but are they getting the information they need in the disclosures to understand the CECL estimates, like how companies came up with their CECL estimate? Is there adequate information around that currently?
I'm sure if I asked them, they would want more. Because every time you ask an investor, the answer is always yes. So probably they'd want more, because then it's easier to understand where the difference in the models are coming from. These are all macro, and it's not, we all know guessing the macro is impossible. Or that's my view. I certainly can't do it. But yeah, more detail in the disclosure would certainly help to understand why there's differences between two different banks. Maybe it's just different types of loans. There might be all sorts of factors, but it could just come down to the macro models, where it's very different.
Thanks, Jared. Any other observations, general observations on the history? Uresh?
Christine, I'm with Jared there. I think more information will be useful, especially how banks are incorporating the macroeconomic forecasts in coming up with their models. That seems to be a bit of a black box. That will be very useful. Also, this is a pretty hot topic in academic research right now. There are lots of papers that have explored how the adoption of CECL impacted banks. The trick was, of course, the difficulty in sort of establishing that was that it got muddled by COVID. But at least the initial evidence suggests that it did change banks' lending activity, especially for the credit capital constrained banks. CECL seemed to have had a bigger effect. They reduced their lending, and also there's a change in their the composition of the loans that banks are extending. So there's been some, you might call these unintended consequences, but some unintended effects of the adoption of CECL in terms of real activities for banks.
Thank you. Marcel?
I'll, with Jared agrees, I'm not a financial, institution expert, but it seems like the objective that was put out to sort of like ensure earlier sort of like recognition of risk associated with loans, which has really stemmed from the financial crisis where it comes from, was achieved. If you sort of just look at that as the most important criteria and what the financial crisis has done to the US economy and the world economy at the time, it definitely achieved that. And maybe just sort of in response to the last comment is that it probably resulted in a lot of banks looking at their loans that they extend and a lot healthier, sort of being more responsible in the kind of transactions that they entered into. So it definitely had a positive impact on the economy as a whole. From a non-financial institution standpoint, CECL obviously impacted companies as well on the receivable side. And I know recently there was an adjustment made, which I think was really a good thing and helpful sort of to do from that standpoint, because receivables were also roped into the standard. But nothing significant from either system or cost or any standpoint like that to implement it on our side as a company. It's just a different of a mindset shift in sort of how you look at stuff. And I think that's the biggest struggle, is getting people, accountants who like to look at a list of stuff and say, this is bad, this is not bad, and then sort of apply like a reserve to having more of a methodology and a historical view of what happens. Is more the problem than the actual application of it from what we do.
Thanks, Marcel. And I appreciate you bringing in the non-financial institutions as well, especially given the standard that was issued yesterday. So I've got Dude and then Jared and Greg.
I do think it makes bankers think differently, which is great. That's a good thing. I also think that the macro models are a little bit like paying no attention to the man behind the curtain. Like it's a little hocus pocus. But nonetheless, on balance, I think it's a positive thing and a value add for banks because it gets them to think about it more and in a different way. So I applaud CECL, even though a lot of people hate it. I don't.
Thanks, Dude. Jared?
Yeah, my comments are along the same line. It's interesting, right now in my fund, we're talking about the issues we're seeing in the private side, and we're looking back at the public side, and we're just not seeing it. I know I'm extrapolating here. There's all sorts of other things like capital ratios that have improved, but I wonder, to Dude's point, like, has this made our banks better bankers? I've got to believe at some level it has.
Greg?
Just wondering if how, as private equity gets into issuing debt, how they're looking at this, or what the chief accounting officers there are addressing this within their organization in terms of their financial statement preparation when they're actually issuing debt as opposed to investing in equity.
Fred?
Oh, just as a response to that, I think it's important that many private equity side is fair value. And one of the questions I think that will be interesting to explore during this process is the CECL allowance and disclosures relative to the fair value analysis and disclosure, and which one of those do investors prefer, and where do they think there's greater transparency? So I think that's a question that we'll be exploring during this process.
Thanks, Fred. Randy and then Uraj?
Yeah, if the question comes down to is there additional cost, there's no question that it is far more expensive to calculate the allowance under CECL. The Dude's comment earlier, historically, small banks would just look at it and go, I know my customers, I know this is what I need. It's not that simple anymore. And the models that are used are more complicated. Yeah, I'll say, fortunately, we really don't know whether this is successful or not, because we haven't had another period like 2008, 2009. COVID was unique in that you had this really short period until there was a lot of government money put in, so the losses didn't appear. The real question is, will the macroeconomic models forecast the downturn when it happens? And as I think about having lived through that period of 2008 to 2012, in hindsight, everybody looks at it and goes, it was obvious. We knew this should happen. We should have had bigger losses recognized. In real time, I don't think people recognized how bad it was. So I'm not sure the models are always going to capture the how bad can it be or how bad is it going to be, just because in real time, you rarely realize what is going on in the economy or to the extent that it's going on in the economy. So we'll know the real answer after we have another financial crisis. Until then, everything works.
Thanks, Randy. Uraj?
I think the previous comment was very much on point. The macro models are not going to predict the next downturn, and we won't find out until we have another credit crisis. With respect to what CECL has done, yes, I do think banks are safer, but partly because they've just withdrawn from certain activities because how the accounting for them under CECL. That doesn't necessarily mean that the risk has gone away from the economy. The risk has just transformed or has moved away from publicly listed banks to other entities that are more opaque. And we won't find out about what the true consequences are until we have another big credit crisis. And that's when we find out where all the bad loans are sitting at that point.
Marcel?
I was thought, Randy, just to sort of reiterate what you're saying, I was thinking about the same thing as I was reading through the materials this morning, is that how the model captures risk inherent in the economy and how quickly it captures it. There's always going to be a lag. I don't think any model will, I mean, most people tend to be extremely positive when they forecast anything. It's just the nature of human beings, and they're never going to go fully negative. So you're always going to have a lag. But I do believe we're better off with the standard the way it is from an economic standpoint, and that's how it should be measured. The success is, did it make the economy safer and the global environment safer? Not the cost of what it costs in systems and people and how much effort it goes into putting it into place. But there's a bigger impact to that, and you're always going to have a lag, because when you have an extreme situation like 2008, the models that anyone sort of look at never goes there. And you can never capture that enough. And it would be interesting to see how this reacts in a situation like that, when you stress test this accounting model against what happens then.
Jared?
I mean, you can make the argument that the COVID crisis, at least for a very short amount of time, was worse than though, I mean, like if they hadn't stepped in with the money they had, it could have gone way worse. And I mean, Randy's right. We don't have, this thing hasn't been fully tested, but it's been kind of tested. And I think it certainly looked better than 08, at least for the short, they did take provisions, those things did happen. Were they right? They were too, well, they ultimately turned out to be too conservative, but you never know outcomes. That's forecasting.
Thanks, Jared. Any other observations about either the costs, the benefits? Anything else from the team's perspective that would be helpful in this conversation?
No, not for me. Just thank you, everyone.
Great. Thank you, Dan. Appreciate it, Alex. Wonderful. So for our last topic of the day, it is a non-technical topic. And I think it's an area of continued interest. It's an area that we've had kind of trickle in various aspects of our conversations, but really just wanted to give some prominence and have a conversation about the use of technology, particularly as it relates to standard setting. So the purpose of this discussion, and we had some broad questions that we shared with you in advance, is really focused on how technology should be considered by the FASB. Specifically, how could it affect the future standard setting, including both the current and future accounting and disclosures and the board's analysis of expected benefits and costs on various standards. I'm going to open it up and see if board members or other staff members have any other observations before we get into the comments, but really looking forward to hearing observations, particularly given some of the dinner conversations about how quickly this area is growing. So Rich or others, any additional thoughts before we get into this?
Yeah, maybe just a perspective. If you think about advances in technology and our role here, from an investor perspective, we're trying to understand, are you doing your job differently? Are you processing financial reporting and accounting differently? And if you are, is that something that you're seeing broadly across all reasonable investors, or is it more concentrated, let's say, in the more sophisticated institutional type investors? From the preparer side, one of the things that we're looking at is there some fundamental change in the cost associated with financial accounting and reporting? Is it here yet? Is it coming? And again, is that something that's unique to the entities, certain entities, but maybe not broadly across the preparer group we deal with? And then stepping back, we got input when we worked on our software project that a lot of the AI spend was in the software range. And I think that was one of the impetuses behind us modernizing the software accounting model so that it could better address how software was developed, and that fed into AI. We have a research project on intangible assets and accounting that is also talking about not only the intangibles, should they go on the balance sheet or not, but should there be disclosure about spend that is not on the balance sheet? So think of R&D and things along those lines, and beyond the definition of R&D. So that may help. And it'll probably be a recurring topic with our advisory groups, because really what we're trying to do is just keep our pulse on these topics. See, is there standard setting we need to do, or a different way we need to think about costs and benefits and how information is used as we're setting standards?
Great. Thanks, Rich. Michelle?
Yeah, I think just from a preparer perspective, I think we've seen like incremental things that have come along. You know, you look at individual systems and there's like some bolt-on things that folks are doing. And, you know, I own our P2P process, and that's probably like the ripest area for me. That's not really financial statement prep. It's like expense report review, like things like that that are feel a little less risky, a little, you know, things that we can just, instead of having 5 people on that team, can I have 3? So that's really where we're starting. And I've talked to a lot of other CAOs and figuring out, you know, what are you doing truly, like anything with respect to journal entries, and folks aren't there yet. I think where we're foraying next is we've looked at some programs that allow you to do like explanations of your financials. So like analytic, that's a very like still kind of manual process that we do to put together close packs and things for our financial statement close process. It's probably where we're gonna go first. I think disclosure review, those types of things, it's helped, but like truly doing like prep of financials, like we're not there yet. I think there's security concerns that, you know, our company has with respect to that. And we're a little bit in a wait and see in that regard. And I mean, obviously in tech, we're pretty like, I think Reddit is pretty good in the AI space in general. And so I think we're waiting and seeing, I think, a little in regards to that.
Thanks, Michelle. Jared?
Yes, at my firm, this is, you know, AI itself is a big topic, and we both insource and outsource money to outside managers. So we've spoken with 5 large institutional managers to try to benchmark ourselves against them. So we've had a lot of these conversations. I would say, you know, the big way investors are using this information is they're building LLMs for each company. I'll give you an example. Like you take a company like Emerson. You go into Bloomberg and you mass download the Ks, the Qs, sell-side research, transcripts, presentations, everything you can get, 3,000 documents, 3,000 pages. You upload it into a data lake and you throw an LLM on top of it, and then you ask it questions. That is the most common use, especially if it refers to what FASB does. You know, and then I built myself a smart little LLM, a mini Google, if you will, and I can ask it any questions I want. From my perspective, there's some concerns there. You know, instead of going into the K, I'll just have AI do it. And we all know AI is not as often inaccurate. So when I think about my analysts, like I'm concerned they're skipping steps. You know, it's why teachers didn't give us the answers. We had to do the problems. We had the debate constantly. And then like, you know, then I'm the old guy in the room that doesn't know how to, you know, and I'm not the one doing the work anymore. So it's like, you know, there's a push and pull between that. And I think there's definitely some advantages to using those types of tools to speed up. Instead of me spending 3 hours to find an answer to a question, sometimes I can find it in 30 seconds. But sometimes that searching and that process, you know, you lose some of that if you speed it up. So, I mean, from FASB's perspective, what you're getting is instead of the Ks getting read, they're being searched through. So you're missing the notes, you're missing some of the context. I mean, that's probably the biggest impact of FASB and a risk to all of us, I guess. And then the next frontier everyone's thinking about is automated modeling. You know, we spend a lot of time forecasting, you know, taking your accounting information and building the future with it. Will robots do that? Right now, very few people are doing that. But that's what people are looking to next, and just completely cutting the human out of the whole accounting finance process. And then the analysts will just forecast KPIs, you know, sales growth, margins, that type of stuff. And then they'll just have a lot less involvement in the Ks and Qs, which I think is unfortunate and also a risk as well.
Thanks, Jared. Marcel?
I think technology actually creates an opportunity for the FASB along standard setting, especially as you evaluate the cost, new accounting standards, and take leases as a good example. It was a fairly expensive, in my opinion, standard to implement because you had to put in a system. And you think about where technology is moving with OCR and some of the other sort of things that AI can and machine learning can sort of add to the interpretation of reading leases. And the time that it takes away from taking that lease, reading it, understanding it, interpreting it, getting it into your software, capturing the data, instead of having a human that can miss something, misinterpret something, or doesn't highlight the certain things that should be considered. And then there's a lot of cost involved in the system through audit, error, you know, differences with some correction that you have in your financial statements, the whole process around the audit. And just maintaining those systems, I think technology and AI specifically will make it cheaper, hopefully, in time to put in certain systems in place that should reduce the cost of some of the accounting standards and maybe some of the things that the FASB would consider going forward, just through the system side of the house. One other thing I just want to, AI is a really complex and difficult thing to implement. And one of my concerns is that you have the haves and don't haves in this world and companies. The rich companies and big companies tend to attract the best and most people that can actually deal with that. There's not that many qualified people. I think it's one of the big struggles for most companies is finding people that can really work in technology. They tend to go to the big companies that can afford it. So you have a huge amount of people out there that doesn't have the ability or would have the opportunity to use AI and technology to the extent that some companies can. And there's going to be a huge disparity in the world, and not just in our world, but across the board in how people apply that. And that's a risk in when you think about AI and the implication in our world, where some companies just will be so much more sophisticated than other ones, and ability to achieve so much more sort of advantages, efficiencies, more effective at what they do. So that's one thing. I think just sort of adding to what Michelle is saying currently, as far as AI goes and sort of in our work day to day, it's sort of limited use and there's, I think one of them is the risk around the exposure of your data or information publicly. People don't trust, even though they tell you that these systems are isolated and you don't have risk of any of it being exposed to information, people don't trust it, kind of thing. So there's reluctance to use it in modeling, but I can see a lot of opportunities, like even goodwill impairments, building out models, looking at forecasts, and how do you do that? You can simplify that if you use it to the full extent. But it's, again, you have a lot of sophistication that you need for people to be able to build that. And it comes down to that at the end of the day. But we don't use it a lot. We use it for research. We use it for memo writing, which is great if you throw in a FASB standard and you throw in say a lot of Ks and you have to do like an accounting memo for a public. It's a good first draft in doing that. So it does reduce time there and helping people to sort of search more broadly, find the accounting guidance. If you think about the volume of work out there, accounting guidance in the US and how long it takes to identify exactly the right guidance, I think it can be helpful, and it is helpful at the moment in opening up to more people to get to the right guidance in interpreting without spending a lot of time. But that's really where it's used mostly at this point in time in my world and from what I've heard.
Great. I have Jason, Bob, and then Stephen.
Yeah, I've several comments on this. You know, we probably see it more given our size and scale, and Marcel's exactly right on the have and have not. So there are some, call them, I'll say maybe Fortune 200, that are going all in. And we've got armies of people out there implementing everything you can imagine at their company to try and take advantage of it. Others are taking very small bites at the apple. Some of it's cost, some of it's nervousness, but that disparity will be huge. But for some use cases I've seen, just for example, right, like we talk about embedded derivatives, I'm aware of a client recently that we helped, and AI read every contract and wrote the memo, and then it was reviewed, and it was 90% correct, right? And so to the least point, right, we people were doing that very easily. In a recent public company share forum that we hosted, I would say this was dominated the majority of the time, and most chief accounting officers or CFOs were lamenting the fact that where technology used to be an investment, call it every 10 to 15 years, it's an ongoing investment now, and the dollars keep growing. And if anything, they're not willing to let people go. They're trying to find ways to use it to free up the people, but eventually that will come. Like if you ask me where it's going 5 to 10 years from now, I think you're going to see a very substantial change. Some of that in public accounting is evidenced by the fact that 2 of the big 4 are reducing university hires by 30 to 40%. And that will continue. So I would just put all of that together and think about how you're going to be doing it. Investments will be bigger. The cost to implement things will go down because technology will do it for you. So just, there you go.
Thanks, Jason. Bob?
Yeah, I was going to go where Marcel and Jason were going on it's good for the first, on the research side, it's good for the first pass, right? Goes through oodles of data, and then you need to put a human eyeball on it and see what it's really telling you, right? But it's good for that. Or like if I had a draft a footnote disclosure, you can probably get every company in your sector and laid out there and what's common and all that. But like even like private equity funds, they get these information memos from their, people selling businesses, and they hit the button for the AI tool, and it gives them a complete synopsis of what's in there. It gives them all the questions to be asking. It does the research out in the real world and says, well, these guys are saying this, but everybody else is saying that. So it helps flag a lot of questions. And then even from the diligence perspective, right, put all your financial data together, put the SIM together, and we can pop out an agenda for a good discussion with management pretty quick. And then again, you got to put your eyeballs on it and make sure it's right, but it's along the same lines, and I'm sure you guys are doing the same thing.
Thanks, Bob. Stephen?
Yeah, so right now I'm at a quant fund, and how we use AI is a lot of scenario analysis. So we use, essentially a baseline, and then you're able to input a lot of the factors into various scenarios, and then detect sort of signals. How the market is trading, how securities are trading. Our fund typically focused on more ETFs, futures. So from a bigger picture, you're able to aggregate a lot more, discern a lot more information quickly, based on the market moves. So that's sort of how we actually adopted AI both on-prem as well as off-prem, just to ensure that our data is we have the rights to the data. So
Thanks, Stephen. Jeff?
Definitely a really good horizon topic for the FASB, I think, and we'll probably be talking about this a long time because this technology is really potentially transformational for all of us, right? And our children and grandchildren and all that. I guess from a user perspective, it's interesting to hear the comments from the users, because I've definitely seen the application of bots and AI on the financials and the questions you get, right? Because I think they run it through the bots, and if there's a variance, boom, they're on it, right? Because you don't have to read it; the bots caught it. They ask you, "What's this variance? You change this word, like why did that change?" And so forth. So I can see that on the other side as well. I think there's at least from where I see it, like I think there's a precision principle. I think that kind of drives some of the way people use it. Like I've seen the users and finance folks be much more comfortable with less precision because they're looking for signals and direction and where are things going. And so I think the AI to me is just like advanced automation, right? We just have more ways to do the bots and things than we used to in the past. They can get to those answers quicker and see the signals quicker. From a preparer perspective, we need greater precision, right? And so it's more humans in the loop, right? Like hybrid models is more what I've seen, at least from a preparer perspective, because of that need for precision. And we're not comfortable putting our hands off the wheel and letting, I've not heard of a lot of people going fully agentic from a preparer perspective. I guess that would be the dream in the future, but I've not heard of it. But I will share that I did see a really interesting use case recently. I was demoed as a use case from Claude, because a lot of the AI can record and then articulate. So you could, for example, walk through a process using Claude, and it produces the charts, the diagrams, the narratives. The whole thing's done. Like you have your team sit for 2 hours, you do the walkthrough, and then boom, I guess in theory, SOX documentation is prepared, or at least it's started, human in the loop, people need to go review and so forth. So I think those types of use cases that get you to that, 40 to 50 to 60 to 70, and the technology is getting better. It's improving, it's learning. And so it'll be interesting to see where this all goes. So, good topic.
Thanks, Jeff. Bob?
Yeah, just thinking through the FASB implications and what Jason said about the public accounting firms and where, or certain of them, where they're going with this 30 to 40% headcount shrink at the coming off the campus, right? That's starting not to be a real secret, right? And as you think about where you get your people, right? Some of them come out of the graduate programs and some come from the firms, right? There may be less younger folks in the profession coming up that's gonna feed your pipeline here too. So there's that to think about.
Thanks, Bob. Michelle?
Yeah, I think along those lines, Hillary and I were just speaking about it. I mean, I'm concerned about not only less people coming in. I mean, I hire folks from public accounting, and it's like, these people have to be able to think. Like, you can't catch an error if you can't like problem solve. So I have some concern about like being fully as a preparer, like fully just like push a button and here's your financial statements and something's wrong in there. It's like, we got to teach people how to think. So that's definitely on my mind in terms of, how I'm thinking about my staff and kind of, reducing workforce. And, you turn on Bloomberg and everybody's like, everyone's going to be down 40%. Look at the profits we're going to make because of this. And it's like, well, like, we got to be careful in how we do this and how we implement it and think through it.
Thanks, Michelle. Marcel?
One of the things that I've heard here from a lot of preparers is that a lot of companies want to make investments, but there's a real reluctance from regulators and auditors for companies to actually implement a lot of these tools because they don't feel uncomfortable assessing the risk, or it's sort of like you have this black box, don't know what's going in and out. So there's a little bit of a break that's being sort of put on and a concern amongst preparers that they cannot move quickly enough, especially large, public companies, people that get audited and so on, that the preparer community, not the preparer, the auditor community and the regulator community is not set up to effectively review, judge these kind of things related to technology, and especially AI and the impact it would have on financial statements and so on, and how companies interpret that. I think one of the things that, and I did mention that the haves and haves not, AI is really, really difficult to implement. And it sounds really cool, but if you actually sit down and you work with it and where do you use it, it's just really, really difficult to implement as a technology, especially in the accounting and the finance world, more than anything else. I think it's great product facing and so on, makes a lot more sense, but it's also expensive. So getting people that can actually do this really, really well, it's just, read an article from Gartner not too long ago that basically in the last year, they haven't seen any huge significant additional adoption of AI across the space of the companies that they've sort of like sort of asked for feedback and so on, and just because of the complexity and cost involved in AI and availability of people to actually do it.
Thank you. Shobu?
So of course, a lot has been said on it, so I don't want to repeat that. But what I see here is an opportunity for accountants, strategists, investors to get a lot more strategic. So a lot of the mundane work, a lot of the grunt work, the heavy lifting, if you will, is getting automated. And the second derivative of that automation is that you're using agentic AI to actually do tasks and a full set of tasks, not just one task. And that frees up time to actually go and look at things on a higher level, on a more strategic point of view for all accounting departments as far as companies are concerned, for all analysts as far as funds are concerned. So it really, I think, it gives that opportunity. And number one, and number two, also it allows for a lot of startup use cases to come up, companies and use cases to come up, and that we're in the process of doing. We already know there's a few companies, for example, out there that are known to automate the process of writing 10Ks, 10Qs, or analyzing those for any changes in verbiage, etc. Now, those companies are going to get even smarter, more intelligent on how they do that, what kind of products they implement, and how real time that becomes. So I think that's what will change immediately. And then, of course, in the medium term, it's all about, what does that mean to the workforce? What does that mean to, allocation of tasks, duties, responsibilities?
Thank you. Uraj and then Jason.
I just want to share an anecdote about what Michelle was saying, the preparedness of the staff that companies are hiring. I mean, at the university, we are feeling the pain of how AI is impacting people and how they learn. There are people who are highly motivated and they're actually leveraging AI to learn better. So these are, teaching, I teach the introductory accounting class to the MBAs, and the ones who are motivated, they're learning more than ever. But then there are the other ones who are short on time and they're just using AI to answer their assignments and all. So what's happening is that the gap between the student who was in the 75th percentile and let's say the 40th percentile was not that big in the past, and now that's just expanding. And somehow we have to find a way to make people learn better. I don't know what the answer is, but I think this is going to impact the people who are entering the workforce and how much they know as they're graduating from college.
Thank you. Jason?
Yeah, well, you teed me up nicely because I was going to comment on Michelle's comment too. It's actually, we spend a tremendous amount of time and money now, not only on the tech, but also trying to train the new hires on how to not just rely on the AI completely, right? So like one example we do at new hire training, it's on purpose, is you put them in a room with a bunch of partners or senior managers, you give them an exercise equally. What you notice is the kids that just started will immediately throw the thing into our AI tools and then just hand you what it spits out. But the partners will sit in the room, old school, and they'll take the piece of paper and they'll read it and they'll make notes and then they'll put it up in AI to see. And the point of the exercise is to tell the young kids like, hey, you can't just throw it into AI. You still got to find a hybrid. So we're trying to pull forward a lot of the skills that they would have learned as they got to senior and manager earlier, because the earlier skills are going to be done by technology. So everyone's trying to figure it out. And at the professor's point, that's more they learn about it in college, the more they just want to rely on it when they get out. So.
Jason, your story reminded me of a senior partner I worked with when I started, who would drive by and have his emails printed out.
Yes.
Grab them and then you had that too? Yeah.
You gotta print his emails.
Maybe that's us now.
Yeah, are we those people?
I was just going to share, like on the flip side, from an entrepreneur's perspective, that you could have a 10-person startup with billions of dollars, right? So that's the other side, is like the AI has enabled some of these companies to do like incredible things with few people and to really do really remarkable things. So it's definitely gonna affect all of us, and I'm super curious to see where this all goes.
Thanks, Jeff. Marcel?
Just think about, Subu, what you said, companies that writing 10Ks and using AI and that. What AI tends to do is it tends to converge everything to be exactly the same. And you can sort of use the design of cars. Just look at how companies use AI. A lot of cars look a lot similar today than they used to look in the past. AI is going to do the same. If you just throw something into a machine, it's going to produce that. It's going to take away the uniqueness of a lot of companies, of really the message that they want to get across in making what distinguishes them from anyone else out there. Think about that. It's a real risk from that standpoint. And I understand it's great. It saves time and money, but it takes away a lot of the value of what the FASB, as a standard setter, that produces or sort of produces guidance on information that people use to distinguish quality companies versus non-quality companies. And using AI and converging everything over time and through putting it in a model just because it saves time, it's actually a real risk for financial standard setting and for reporting for all of us. And how do you capture that in time? And then, I'm not even going to go with people not understanding. It's like engineers that get trained, but they don't understand how the machine works. They just know how to operate it. So when it breaks, nobody knows what the hell's going on.
I can relate to that one. Randy?
One thing occurred to me as listening to this is the question that teed up how and what impact is this going to have on FASB and standard setting. Because everybody is going to be using AI to do the research, the question may be, do the standards need to be written differently in anticipation of the way AI will read the standard and apply it? I don't know what that answer is, but it is, our experience is much like everybody else's. AI is, you run a contract through AI, it's like giving it to a young staff person. You get some of the answer. If it's a very technical issue, though, it's not very accurate today. And it even when you try to point it to the exact literature, sometimes it still concludes differently than what the standard actually says. So I don't know what words would have to be changed, but it may impact how the standards are actually written.
Well,
Thanks, Van.
that's something, I guess, certainly on my mind is, will we have to do that in the future? And if so, how? I think we've had a number of these discussions, and at this point, we haven't heard any magic bullets or need for change. But it's something that we are keeping, or at least I'm keeping top of mind. So any thoughts are welcomed.
Jason?
I would actually recommend just piloting, having large language models actually write the standards and see what you get. Just play around with it, actually, and see. Put in what you want the intent to be, and put it through a couple and see how it writes it, because that'll tell you how it'll be read.
Great point. Uraj?
So, one thing that LLMs process differently is text versus images. So that's something to keep in mind. Like, at least the current version of LLMs are not as good at processing images versus text. And I think it also has implications for something we were talking about KPIs earlier. I mean, they are just predicting what the next word is. So if companies are not defining something very, very carefully, they are going to hallucinate, and they're going to pick up, they're going to guess what that next word should be. And I think that has implications for how FASB writes standards.
Great, thank you. Jude?
It's going to be a hell of a while before we see AI build a road or a bridge.
I appreciate that. Any other final thoughts on it yet, Greg?
Yeah, my final thought is just bringing back some history into accounting, and not to throw Jason's firm under the bus, but 20 years ago, after Sarbanes-Oxley came out and the accounting firms needed to shed their consulting practices, KPMG spun out Bearing Point as a public company. And the intent there was, from the financial reporting, was to be able to push the button. And I was involved in 5 years of financial statement or restatements there. They pushed the buttons, they set out the financial statements, the SEC, it started with comment letters, and then the comment letters blew up, and then it was revenue recognition, and then it was restating revenue for 5 years and restating all those Ks and Qs. And then the demise of Bearing Point and Mickelson changing golf hats again.
Should have kept more accountants.
Yeah.
Any other thoughts or suggestions, advice? No? If not, I'd just like to thank you all, not only for the conversation that we had on this topic, but for your attention, for your preparation, for your candor throughout our discussions today. It's really been terrific for both people that are in the room with us as well as online. So just thank you all for that today. I also just want to extend, as I mentioned this morning, a special thanks to Jessica, to Jonathan, and to Ryan, our 3 members that have completed their terms. And also thank Alden Schroeder. This is his last meeting. He's leaving the FASB at the end of this year for the next step of his career. And we really appreciate all that you've done for the team and wish you the very best. So also big thanks to Lucy and the rest of the team, because without them, these meetings wouldn't happen and they would not be organized nearly as well as they are. So just really appreciate all that they've done to make this possible. So we look forward to seeing you again this spring in May. We've got the meeting dates listed up here. So Thursday, May 14th and Thursday, November 5th of 2026. Wish you all a wonderful holiday and a safe travel back to wherever it is you may be going next. So thank you.